Shauna Smith alongside Madison Mills, and this is Yahoo Finance's flagship show, The Morning Brief. Let's get to 3 things that you need to know today, starting with today's latest read on inflation.
That's right, PCE, the Fed's preferred inflation gauge, showing price pressures cooling in August. The index rose 0.1% for the month, putting the 12-month inflation rate at 2.2%, just above the Fed's inflation target of 2%. You can see on your screen stock futures moving to the upside off of that news.
Chinese equities capping their biggest weekly rally since 2008. The moves coming after China's central bank announced a massive stimulus package to help boost the world's second largest economy. Now taking a look at some tech Chinese stocks, including Alibaba and Tencent. Both of those stocks plus more are hitting their highest levels that we've seen in more than a year.
And Costco earnings out with signs of consumer spending shifts. Members starting to spend more money on non-food items as inflation continues to slow. Costco also announcing a membership price increase earlier this month for the first time in 7 years. We will see the impact of that hike reflected in next quarter's earnings.
Let's get to the latest reading on pricing. PCE, that is the Fed's preferred inflation gauge, showing that pricing pressures continue to cool during the month of August, largely coming in line with economist expectations. Here to break it down, we want to bring in Yahoo Finance's Fed correspondent, Jennifer Schomburger. Hey, Jen.
Good morning, Shauna. That's right. Inflation continued to drop in the month of August, actually clocking in cooler than expectations on certain fronts. On a headline basis, the Personal Consumption Expenditures Index rose 2.2% in August, compared with estimates for 2.3%. That's down from 2.5% in July. Month over month, in line with expectations, up 0.1%, which is also 0.1% lower from the previous month. On a core basis, which excludes those volatile food and energy prices, a basis on which the Fed prefers to examine inflation, PCE rose 2.7% for the month of August, in line with expectations, and up 0.1% from 2.6% in July. Month over month, things looked better. Core PCE up just 0.1% versus expectations of 0.2%. Today's reading likely to keep the Federal Reserve on track for 2 more 25 basis point rate cuts. Though you look at those Fed funds futures this morning and investors pricing in now a better than 50% chance of a 50 basis point rate cut. So the market hopeful there. However, the fact that core inflation is holding the level of the past couple of months year over year and not dropping lines up more with a scenario for a 25 basis point rate cut. If a 50 basis point rate cut were to be considered, we would need to see substantial weakening in the job market between now and the November policy meeting. We learned from Adriana Kugler, Fed governor, that if core PCE inflation were to clock in at 2.7, that would be in line with her expectations for the current path of rate cuts. We also know that Fed Governor Michelle Bowman is particularly concerned about high core inflation, and Atlanta Fed President Raphael Bostic has also lingering concerns about inflation, which has caused him to look at a slower rate cut path. The next big test for the Fed will be next Friday with the jobs report. Back to you.
All right, Jennifer Schomburger, thanks so much. As always, appreciate it. Well, that inflation data moving closer to the Fed's 2% target for the month of August, and the 12-month inflation rate coming in at 2.2%, slightly below economists' expectations of 2.3%. For more on the state of the economy, we are joined by Tiffany Wilding, PIMCO Managing Director and Economist. Tiffany, thanks for being here. Just want to start with your reaction to the data and how you think it'll impact the Fed's path forward here.
Yeah, well, first of all, thanks for having me. I thought overall today's data was sort of broadly in line with expectations. Obviously the PCE inflation report, much of the source data from that comes from the CPI, which we got earlier this month. What I would just say is that we've come on a string of pretty good inflation readings over the last several months. And that was coming after an acceleration in inflation in the first quarter. So I think Fed officials are feeling pretty good about where inflation's sitting. I think the more important thing is that labor markets have loosened quite a bit, and on some measures are now looser than where they were in 2019. So if you look at the vacancies to unemployed rate ratio, or even obviously the unemployment rate, it is looser. So they're not worried about inflation. They're not as worried about inflation moving forward because the labor markets are just not as big of a source of inflationary pressures as they were before.
Do you see anything, Tiffany, in the labor market, the softening, some of that softening that we have seen in recent months? Is it anything to worry about yet?
Well, I think that, the kind of bottom line for us is that labor demand has certainly cooled quite a bit after the, sort of acute labor shortages and elevated labor demand post-pandemic. And the speed at which labor demand has decelerated is obviously concerning some Fed officials. But I think there is some good news here under the surface, which is that we haven't started to see any sort of indications of broad-based layoffs, which you tend to see, ahead of recession. So what we have is just an economy that's cooling, and you have folks that maybe aren't hiring at a pace or aren't needing to hire at a pace that they were previously over the last couple of years, but certainly they're not shedding labor either. So we're kind of getting more back to normal is how we would describe it.
Yeah, and Tiffany, I was really interested in the notes you sent over, the focus that you have on revisions and how that could tie into the labor market data. How much should we be trusting something like that key NFP print next week that we're, of course, all looking forward to? Should we really be kind of hanging all of our hats on that data given the extent of the revisions we've been seeing?
Yeah, well, so the revisions that we've seen to economic indicators, both the labor market indicators, but just more broadly, the growth indicators have been quite big lately. And I think that's part of the reason why just in general, the economy has been a bit harder to read just because the statistics are getting revised pretty heavily. Obviously earlier this month, we had, a preliminary revision, which suggested that there are 800 fewer jobs created in 2023 than we thought previously. Still, according to the establishment survey, about 2 million jobs created over that year. And separately, we have broader revisions to the growth statistics, which really suggest the U.S. economy has been humming along. It's been very resilient throughout this post-pandemic period. Monetary policy increases had a much less of an effect than previously thought. So overall, what we would just suggest is that we're kind of getting back to normal. There was a series of shocks post-pandemic that really kind of knocked the economy in various ways, and we're just normalizing from that. And it'll take some time in addition, but the thing that isn't normalized, by the way, is monetary policy. And so obviously that's why the Fed, needs to kind of get going in terms of getting things back to more normal monetary policy as well.
Tiffany, do you think the 50 at the next meeting, should that be in discussion now? I know your base case is for 225 basis point cuts, but the talk of 50, I guess more so, what is that threshold, do you think, that would prompt the Fed to go 50 at the next meeting?
Yeah, I mean, obviously, I think the labor market reports, which you talked about, are very important, and that's really going to be the focus. So next week's job report, we think there's a potential for it to come in weaker as well. I think one of the things that we've also been focused on is the upcoming election. There's policy uncertainty that's elevated as a result of that. It's a very close race, and when we look back historically around elections, and particularly elections that are very close in terms of pre-election polling, you actually tend to see companies that slow their hiring and slow their investment. And that tends to start about 6 months ahead of an election. So we think we are starting to see that. That's one of the reasons why you've seen a step down in the labor market data. And it suggests to us that we're going to continue to see some weak prints here until we get more clarity after the election. I certainly think the Fed could react to that. When we think about Fed policy, I guess what's less important to us is not, the meeting by meeting pace, but more about where the rates are going to get, kind of over a 25 out to 2025. And we think the markets are pretty fairly priced in terms of, kind of where the neutral rate is and the balance of risks around that. So we, again, focus on the sort of more medium term look here.
Tiffany, you mentioned the election a couple of times, and I want to dig into that just for a second, because we did hear a little bit more about the economic plans of Vice President Kamala Harris this week. We heard from former President Donald Trump, obviously everything from manufacturing plans to tariffs, and something that we've heard about for quite some time. I guess my question to you is, one candidate better than the other in terms of the economic policies that we've heard so far for the economy, or what is your read into that?
Well, I think it's, both. I think what is very bipartisan is this understanding that the U.S. needs to focus on so-called industrial policies. The government needs to help create industrial policies, and that focus has grown more so than call it in the decade or two before. So you saw that with the Biden administration, the various industrial policy legislations that they passed, and of course the Trump administration before that, with a very big focus on industrial policy through tariffs and a focus on bringing manufacturing back to the U.S. I think both sides sort of differ in how they want to implement that industrial policy, but I think everybody agrees that that's important for the longer term competitiveness of the U.S. economy. Now, what I would say is that post pandemic, just looking at the economic performance in the U.S. versus other countries, I think there's some pretty encouraging news there. The U.S. has come out of the pandemic with investment trends that have been stronger than our developed market peers, and productivity growth that's been much stronger, than other developed markets. So I do think, looking at the data so far, I think there's some good news there about the trajectory of the U.S. economy. And I think any of the either candidate will have that focus on industrial policies for the future as well.
All right, Tiffany Wilding, always great to get your insight. PIMCO's managing director and economist. Thanks so much. Let's hone in on the consumer. Costco shares are sliding in pre-market trading. The big box retailer's revenue falling slightly short in fourth quarter earnings report as consumers pulled back on spending on those higher priced items, also lower gas prices hitting Costco's profits. Here to discuss those results and what they say about the broader retail sector, we want to bring in Bill Kirk, Roth Capital Partners senior research analyst. Bill, it's great to have you here. So first, let's zero in on Catalyst. Let's zero in on Costco right now. When you're taking a look at this stock, I guess, why do you think we're seeing such a reaction to the downside? Is it because maybe this stock does lack a catalyst at this point?
I think it's more how the stock and the company is viewed. It's universally loved. It's operating extremely well. And the valuation in where it trades reflects that. So it is to some degree priced nearly for perfection. So any little pause in momentum, any little hiccup in margin is accentuated when you have a valuation that high. And so they're still gaining share. Their member age is getting lower, which is wonderful. Pharmacy's up double digits, optical's up double digits, e-commerce is up nearly 20%. They're still doing lots of things very well, but they're not necessarily accelerating. And when you have a valuation as high as 55 times on PE, you kind of need to continue to accelerate. When you start to maybe stall, even at wonderful levels, that's when maybe you give up a little of your gains.
Bill, is the valuation issue idiosyncratic to Costco, or is it about consumer discretionary overall, which has been the biggest gainer sector-wise for the month?
It is most elevated at Costco. So Costco carries the highest multiple in any of my coverage. Its multiples more than double what Walmart's is. And if it's 55 times PE, that dollar of earnings you're paying 55 for, even if that grows at 10% per year, that's going to take you 20 years to get your 55 back. So it's a long payoff period for a company that is consumer staples, consumer discretionary, and kind of limited in those parameters.
Is it still well positioned, do you think, to take share? And I guess what does that timeline look like, and in what scenario? I guess if we do see the economy able to avoid a recession, I guess what does the upside then look like for Costco versus the fact that you could make the argument if we were to see more pressure, maybe more people then will be shopping at Costco?
Their value offering obviously does very well in all environments. Where if value seeking increases, they offer some of the best value available in core high frequency items, especially like grocery. So there's a lot of value to see there. They're also seeing a little bit of shift from restaurants. So they noted on the conference call that they're seeing a little shift from away from home spending toward at home. And they called out some of their kind of ethnic food options as where they might be seeing that, or as evidence of where they are seeing that. In terms of their positioning via share, they're going to continue to gain share. Part of the more bearish case a few years ago was how do the youngest cohorts, how do the young family formation, how do they adopt club shopping and membership shopping? And for Costco, they've come into the stores very willingly, eagerly, and you can see it. They say their membership age continues to fall, right? The age of their members, and that's a wonderful long-term sign for gaining share. And to be clear, they're absolutely, I mean, their comparable store sales are nearly 7%. That's the best share gains in kind of the larger retail food and staples world.
I want to end, Bill, with Walmart. I know it's your top pick. Talk to me about your bull case for Walmart.
So what Walmart's doing that's new, Walmart is competing on convenience for the first time in a long time. So if you think of Walmart from the last 10, 15 years, all they could really compete on was value. They had the same 5,000-ish stores, and they were as convenient as they ever were going to be. However, COVID pushed people into a digital shopping environment, and that allows Walmart to compete with new customers for the first time that are still kind of out of the range of those 5,000 stores. So they're now able to offer a convenience element that wasn't available to them on top of being one of the most value-positioned retailers. So that is a whole new paradigm that is available to Walmart and is leading to them gaining share. All the small little grocery stores that had been lucky enough to not have a Walmart physically against them, Walmart is now digitally against them.
All right, Bill Kirk, thanks for joining us. Bill is with Roth Capital Partners as their senior research analyst. Thanks so much. Coming up, we're taking a look at what is trending on Yahoo Finance. We'll get you those tickers right here after the break.
Chinese stocks moving higher once again today, building on this week's rally following the announcement of Beijing's economic stimulus plan. Yahoo Finance's Akiko Fujita joining us now with 3 charts to explain the story. Hey, Akiko.
Hey there, Shauna. Yeah, those gains we saw this week mark the biggest single weekly gain in nearly 16 years. Those blue chip stocks on the CSI 300 index rising 4.5% on Friday, up nearly 16% on the week. And then over in Hong Kong, we saw the Hang Seng index up nearly 13% for the week. FOMO certainly kicking in on Friday here. Bloomberg reporting share turnover reached more than $100 billion in the first hour of trading over in Shanghai, and that delayed processing orders as traders really tried to get in here. All of this coming on the back of measures we have seen the government take to shore up what has been a slowing economy. On Tuesday, remember, we saw financial regulators announce a string of measures, including interest rate cuts to ease lending conditions. One of those changes we saw take effect on Friday. Now, regulators also announced that banks would be allowed to lend to companies to repurchase their shares. That, of course, a move aimed directly at restoring confidence in the market. On Thursday, it was Chinese leadership saying that China would deploy, in their words, the necessary spending to reach its stated growth target of 5%, calling for the forceful implementation of policy. And then they also committed to taking action to make the property sector stop declining, which of course has been the biggest laggard on the economy. Now, the question moving forward is what that spending will look like and how effective it will be in shoring up the world's second largest economy. The country has publicly stated its growth target is 5%, but there's increasing skepticism about China's ability to reach that target, given the slowdown we have seen in a number of economic data that's come out in retail sales, industrial production, the increases we have seen in youth unemployment. And then, of course, we've been talking about how that's led to some downgrades here. Goldman Sachs and Citigroup already lowering their full year projections to 2.7%. Of course, the question, guys, moving forward is going to be what exactly this forceful spending is going to look like. Those specifics not necessarily provided by the Chinese leadership this week, but bringing it back to the U.S., we've been watching U.S.-listed Chinese companies, those shares, to see how much of that trade that we saw overnight will trickle down into the U.S. trade as well. Those stocks all, including Alibaba, Baidu, JD, all those have been getting a big bump here. K-Web, another one of those that we watch very closely from Crane Shares, also getting a bump on the week. So the sentiment is good, at least for this week. But the question, of course, will be how much of this momentum can be sustained, especially given that the implementation is going to be the most difficult part, and those specifics haven't been provided yet, guys.
Yeah, absolutely, Akiko. A lot of questions still remaining, especially about the transparency from the PBOC, but certainly something that is driving those stocks much higher for the week, as you said. Akiko Fujita, thank you so much. Well, Bristol Myers Squibb shares surging, the FDA approving the pharmaceutical giant's schizophrenia drug, making it the first new drug-related approach for the disease in 30 years. You can see those shares up over 3% right now. The drug's going to be available in late October. 3 million people have schizophrenia, but only about half of them are medicated, Shauna. So I thought that was interesting, just the potential degree of growth that could come as people hopefully get more access to the pills.
Yeah, and I think one of the pushbacks from people who have been prescribed these pills is some of the side effects. So the fact that this medication does not come with a black box warning label, which if you're not familiar, that label is one that indicates a serious safety risk or other side effects. That is a significant positive, is to put it in the words of some analysts here, significant positive for Bristol Myers and the stock moving forward. But for people who are prescribed these drugs or who need to take this, the reason why this is also significant is because it doesn't have some of those side effects, which included in the past gaining weight, falling asleep, experiencing involuntary muscle jerking, which then had caused many patients to stop taking some of those traditional antipsychotic drugs. So again, the fact that this drug, at least as it appears, does not seem to have those side effects that could really help wider adoption and, of course, help those who are in need, who need this type of medication. And then, of course, when you talk about the business side of things, what ultimately this means for Bristol Myers Squibb, the fact that they do have exposure within this now and the fact that they do have a drug that doesn't have those side effects, when you talk about mass adoption and maybe what demand is going to look like, that obviously could be a bullish sign here for the stock going forward.
Absolutely, yeah. And right now it's going to cost about $2,000 a month, so it's not exactly super affordable, but of course with healthcare, we will see what that cost comes down to, Shauna.
And we will continue to follow that. All right, let's get to another story that we're tracking here this morning, and that's DirecTV and Dish reportedly in advanced merger talks. The deal may be finalized as early as Monday and will create one of the nation's largest pay TV providers. To discuss, we have Yahoo Finance's very own Alexandra Canal. Allie.
Hey, Shauna, yeah, another big merger potentially on the horizon here. But remember that this isn't the first time that these companies have discussed a possible combination. Back in 2002, the FCC blocked a proposal to merge the two entities, citing antitrust concerns. But it's a much different environment this time around. We have waning market power across the board when it comes to these satellite TV businesses. Subscriber losses has escalated, as you're seeing on your screen, with more consumers cutting that cord in favor of streaming services like Netflix, Amazon Prime, Hulu, etc. And because of this period of secular decline, analysts have said it's clear a merger should happen and it should be cleared by regulators. That being said, though, MoffettNathanson analyst Craig Moffett said in a note to clients that although consolidation during a period of secular decline is always to be expected, it would, quote, be a mistake to overestimate its importance. Adding a year or so to the expected life of satellite TV isn't going to change the narrative for programmers, distributors, or even for satellite TV. Now remember, DirecTV was spun out from AT&T into a joint venture between the telecom giant and private equity investor TPG back in 2021. At the time, DirecTV was valued at about $16 billion. Meanwhile, Dish has been burdened by a lot of heavy debt, hence the desire here for its parent company EchoStar to strike a deal and receive some of that relief. A deal could be reached as soon as Monday, guys, according to these reports. So we'll be tracking that and we'll keep you guys posted.
We will. All right, Allie, thanks so much for breaking that down. Keep it right here on Yahoo Finance. Much more coming up ahead. We've got the opening bell in just about 4 minutes. We'll be right back. Just about a minute away from the opening bell on Wall Street. Let's do a quick check of the markets. Here you've got the future action up on your screen. You've got all three of the major averages on track to open the day in the green. This coming after the latest inflation print that we got out this morning. PCE, now that is the Fed's preferred inflation gauge, once again showing that pricing pressures continue to cool. So ultimately, what does this mean for the Fed? Largely, the quick reaction here this morning is that it actually strengthens the argument that maybe the Fed is only going to go 25 basis points here at the next meeting. Let's pull up where things stand here today and really the action that we have seen over the last several trading days, as we have seen the markets hitting record highs this week. Taking a look at the 4-day action on a sector basis, you're seeing materials, technology, and consumer discretionary leading the way. On the flip side, you have seen energy stocks lag here this week. You've got the energy sector off just over 3.5%, followed by healthcare and financial. So a bit of a split picture on that weekly basis. And taking a look at the Nasdaq, some of that performance that we've seen in some of those larger cap tech names, actually largely speaking, many of those larger cap tech names on track for losses here over the last couple of trading days as we start today's trading day. But NVIDIA, one of the standouts here so far this week. Let's kick it over to Jared Blickery for a closer look at some of today's movers. Jared.
Well, thank you, Shauna. I'm going to go back to the S&P 500, the kahuna here, and I'll chart the price action. This is over the last 2 months. Just want to show you that we were at a record high yesterday once again, and that is the 42nd one this year, pointed out by Ryan Dietrich over at Carson Group. 42nd all-time high for the S&P 500. Eastern religions such as Buddhism and Hinduism believe that people reach nirvana at age 42. So welcome to nirvana, and we'll see if that continues. I am watching the dollar versus the yen, and that has been sinking a little bit. There's a big red candle. Let me show you a line chart. This is something that's caused consternation in the markets. As we know, in months past, Yen-mageddon, as I was calling it, had to do with lower prints on this particular cross. That means the Japanese yen is strengthening, the dollar is weakening. And so the yen is strengthening once again, the dollar going down, and so that's something that we want to watch. I would wait for it to get to 141 before I get concerned. And Shauna, I was looking at the 4-day price action as well. Let's do a 5-day now that the day is open. And guess what? Consumer discretionary now edging out tech, but materials is the big winner. And I'll just show you a quick 5-year chart. JC Peretz noting that this is a big breakout here for the materials sector. And then I got to go to China. China having its best month since November of 2022. And this is the 5-day price action. Very impressive, where you see BABA up 20%, Pinduoduo up 33%. I got to say, this looks like the start of a larger move, especially since David Tepper going kind of all in, saying he likes the space here. I do pay attention when he likes something that has been beaten down. Now, I also want to show you the Bitcoin breakout that we're looking at. And this is something that I've been tracking. I'm going to redraw some lines I put in a few days ago. And here is a trend channel. And you can see it is just barely breaking out. My one caveat is that Bitcoin is famous for breakouts, false breakouts to both the upside and the downside. So if we start heading back down here, we could be due for another test of that lower end of the trend channel. Otherwise, higher highs, record highs probably in sight.
All right. Well, thanks for giving us that cautious optimism there, Jared. We always appreciate it. Thank you so much. It's time now for today's strategy session. Treasury yields still moving higher over the last week, despite the Fed cutting rates by 50 basis points, with yields steepening, particularly at the long end of the curve there. So here to make sense of all the bond market moves, we've got Angelo Korkofis, Edward Jones, Senior Investment Strategist. We've also got on set with us Blake Gwynn, RBC Capital Markets, Head of U.S. Rates Strategy. Thank you both for being here. I want to start with you, Blake, because we have these moves in the yield curve that are not really making sense to me, given what the Fed is doing here. How are you making sense of it?
Yeah, well, I will say, basically since the meeting, it's been kind of chop city. I mean, we've been back and forth.
I love that.
Curves kind of went steeper. Now we're coming back in flatter. So it does seem like the markets are really trying to get a handle on what's going forward. But I think we're kind of in the same place that we were before the Fed meeting. So even though we got that larger cut, I think Powell paired it with some very positive economic language. The dots were a little bit hawkish. So we're kind of left in the same spot where we're looking at each meeting coming up and saying, is it going to be 25 to 50? Terminal rate that market's expecting hasn't moved all that much. I think one reason we're seeing rates go up though a bit is, he did draw a line and say, look, we're not going to let things deteriorate any further than they have. So I think that may have given some confidence, confidence to the markets.
Does this signal anything worrisome to you? It doesn't sound like it. Does it? It more just sounds like it's a correction in the pricing that had already been priced in.
You mean as far as what Powell is communicating?
Yeah, and the bond market's reaction to that.
Yeah, I think there was a concern going in that, if they did 50, that, the Fed knows something we don't, or they're getting very concerned. But I think Powell actually at the press conference did a very good job in kind of nipping that story in the bud because, as I said, he was pretty positive on the economic outlook. He made it very clear. He said recalibration like 5 or 6 times during the press conference. He said this is a recalibration. We're getting back to something that we would consider more neutral. This isn't because we are very concerned about near-term downside risks or anything. So I think he did a good job at doing that.
So Angelo, recalibration, chop city, as Blake likes to call it. How are the bond market moves and the Fed moves impacting your view on the equities market? Has anything made you a little bit less bullish?
Yeah, clearly this critical point, turning point in the Fed cycle has broad implications not only for fixed income, for equity markets and market leadership as well. To us, the Fed's proactive approach reinforces and strengthens the case for a soft landing, which is undoubtedly positive for equity markets. In the past, whenever the Fed has been able to cut rates and start an easing cycle because it can, instead of because it has to, it has corresponded with strong forward returns. One thing that is different this time is that US large cap equity valuations are elevated. But the good news for investors is that many other segments of the market trade at lower PEs and have some potential for catch-up. So even though we would not expect valuations to rise as much as they have in the past, whenever the Fed has started cutting rates, there are ways for investors to take advantage of this turning point, which is no doubt a sizable one.
Angela, what are some of those ways?
Either we talk about some of the cyclical sectors, mid-cap stocks, which we like. They offer a nice balance between quality, lower valuations, and the potential to catch up. And also potentially some high-quality dividend-paying stocks that they have been out of favor over the last couple of years.
I want to go back to you here, Blake, because one thing that I can't stop thinking about is that GDP data, the revisions yesterday showing that, hey, maybe things weren't so bad coming out of the pandemic. Maybe people had a lot more cash on hand for spending. And I'm a little concerned that could lead to a reignition of inflation. Are you, as the bond market?
Yeah, I mean, it's not our modal call, but I think there are some upside risks around inflation. And, if you look at our kind of forecast for where the Fed's going to cut to, our terminal rate, it's much higher than markets are expecting. We're at 4 to 4.25. Markets are pricing much lower than that. The Fed's dots are much lower than that. And I think part of that is because, one, as you said, we think the economy is probably, on a lot better footing here. Consumer balance sheets, corporate balance sheets are doing very well. We think, when you look across the spectrum of data, it's really not as bad as a lot of the negativity over the last few months has suggested. And then you layer onto that these inflation pressures you're talking about, where, we could see some pent-up activity that's kind of unlocked after the election. I think there's some people kind of waiting for clarity on the election, waiting for the cutting cycle to have started. So I think there's going to be a little pent-up activity into the end of the year, beginning of next year. Also, we've seen this residual seasonality in inflation data. So it's good right now. But we've seen before, we've gotten a head fake. It was very good last fall as well. And then, we got that very hot inflation data in Q1. And so I think that's kind of where we're coming at with that higher terminal call, is that we get into Q1 of next year. Things are fine on the growth and labor side. You start to see some of these potential upward, inflation pressures. Yeah. And we didn't even mention the election and what could happen to immigration, all inflationary. So, we think the Fed could find themselves in a place early next year where a pause starts to make sense. And it looks more like 95, 98, 2019.
Angela, how does that compare to your terminal call? And I guess what does that tell us then maybe about, is there limited upside to the upside here for equities?
At the broad level, you have an economy that is still holding up well, while the Fed is cutting rates, starting a new cycle with financial conditions easier than in the past whenever they have started to cut rates. And on top of that, as we learned this week, you have Chinese policymakers that are taking decisive actions to really put a bottom in that economic weakness that we have seen. So I don't think, despite some of the near-term headwinds, the elections being one of them, I don't think that changes the uptrend in equities, but it's not going to be a straight line higher and to the right. There's going to be bumps along the way. And I do agree that it's not going to be a smooth path towards that, 3% or slightly under 3% that Fed officials outlined. But at the same time, the path of least resistance for yields is lower. And we think for equities is higher in this backdrop.
Blake, I want to turn to you here for as we round up this conversation. And given your time at the Fed, I'm curious what you make of the fact that Bowman was a lone dissenter and the fact that it was the first time that we've seen a governor dissent since 2005. The significance of that, and maybe walk us through maybe what that tells us about the ongoing discussions right now.
Yeah, I mean, to be honest with you, it didn't surprise me that much. I mean, I think Bowman's been pretty clear about some of kind of her views. And honestly, I think you might have seen a dissent in either direction. I think, we can debate whether or not that was kind of intentional or deliberate to maybe soften the blow a bit, because markets were so hung up on this 25-50. I'm not that surprised that either way it went, there was a dissent to kind of say, hey, look, we weren't all in agreement with this. I will say the communications around, I just praised Powell a second ago for his communication at the meeting. I think the communications around the meeting in sense have been very confusing for markets, whether they're more focused on labor deterioration, but then we come out of the meeting and we hear Waller kind of saying, well, low inflation prints are enough to get 50s. I think there's been some confusion around their reaction function, what they're thinking about, and it's been very difficult to kind of interpret Fed communication recently, I think.
Yeah, I think we've seen that reflected in market pricing as well. All right, well, Blake, great to have you here on set. Thanks so much. And Angelo, of course, our thanks to you as well. Well, NVIDIA rallying this week. We break down what's next for the chip giant after the break. Stick with us. Nvidia shares are in the red today, off just about 1%, taking a breather from its most recent rally. The stock had closed higher 4 days in a row. The move to the upside on the back of CEO Jensen Huang no longer selling the chipmaker stock, at least for the time being. Also, some of that optimism playing out not only in Nvidia, but more broadly the AI chipmaker space. That was fueled by Micron's strong earnings report. So here to discuss what might be next for Nvidia, we want to bring in Richard Windsor. He's Radio Free Mobile founder. Richard, it's great to have you here. So talk to me about Nvidia. Here we are today. We're seeing a slight move lower, but we have seen this return of optimism, to say the least, surrounding Nvidia. Where do you think the stock is headed from here? Is there much room to the upside?
Well, I think it really depends on the overall macro. If you look at artificial intelligence in general, and you want to have a position in artificial intelligence, then Nvidia is definitely one of the lowest risk ways to do that. Simply, if you compare that to other, particularly in the private markets, companies like OpenAI, where their valuations are far more stretched. Now, the question you have is over what do you think is going to happen to the market overall? Because Nvidia has a high beta, it's very volatile. If the market sells off, then Nvidia is going to go down more than the rest because it has this high beta. And that's really what I think is going to govern, certainly for the next quarter, because you can have no more data points out of Nvidia until at least another 3 months or so. And so consequently, I think it's going to go back and forth, I suspect, in line or amplify the signal of the market rather than anything specific to Nvidia.
Yeah, it's interesting. I'm looking at a chart right now indicating that while Nvidia was the biggest driver of gains for the S&P in the first half of the year, now Apple has taken over that top slot. Is that a bearish signal for Nvidia moving forward, or is it a sign of more kind of volatility in the broader market? How do you read that?
Honestly, I think it's just more of a normalization. If you look at Nvidia's year-over-year gains in the first half of this year, and also the degree to which the company beat expectations, it's not such a huge surprise that that was the major driver of the S&P in the first half. You look at it now, you're in a situation where very, very big growth is expected in the stock. The year-over-year comparisons start to become more challenging, and so obviously you're going to see the performance of the shares come back somewhat. And I think really that's all that's going on here, because simply if you look at the outlook for Apple, which shipped a brand new product without its main feature, and the outlook for Nvidia for the second or the fourth quarter of this year, frankly, I would be more interested in Nvidia than I would be in Apple.
So, Richard, when you talk about the upside here for Nvidia, obviously I don't think it's much of a debate right now just in terms of the dominance of their position. But I think the question is what exactly that market share looks like 5 to 10 years from now. I'm curious how you see that playing out with the rise here of some of its competitors.
Yeah, that's a really great question. And the reason being is on a 5 to 10 year horizon, there are some very serious challenges to Nvidia's position, because really what's happening is Nvidia at the moment, all the key decisions are made around what silicon platform I'm going to develop my foundation model to. That's the key decision, and Nvidia totally controls that segment of the technology stack. In 5 years' time, that might be very different. People may asking different questions. So not worrying about developing to silicon, but maybe developing to the foundation model or higher up through the technology stack, where Nvidia's current position is much weaker, and that gives its competitors a chance to get in. So long term, 5 to 10 years, yes, there's a challenge. Short term, 2 years, which frankly is more than the market really cares about, I don't think anyone is going to get close to Nvidia in this generation. And so I think market share 2 years, pretty safe.
Let's switch gears a little and talk about OpenAI. The CFO talking about the company's funding round, valuations looking at about $150 billion in that funding round being oversubscribed. What do you make of that $150 billion price tag?
How this company can value itself at $150 billion, frankly, is beyond me. If you look at the overall market, OpenAI no longer has a massive technology lead. If you look at what Meta was talking about this week, they've provided their best model to the open source for free. And so consequently, if you look at OpenAI's valuation, 30 times 2025 revenues on an optimistic scenario for a company where almost all of the founders have left, the key brains of the company left this week, So, that valuation looks incredibly risky to me.
Richard, going from nonprofit to for-profit, I guess from an investor perspective, it would probably make it a lot more attractive for investors. What do you think?
It's an absolute must-have, because if you're a non-profit and you don't generate any profits, then the value of your equity is zero. So that is a given in the numbers. And so that's why I think, if you look at some of the term sheets that are going out, my suspicion is that there's a promise in there to turn into a proper for-profit company over the next year or so, because quite frankly, if it doesn't, then the company's not worth anything at all.
All right, Richard Windsor, great insight. Thanks so much for joining us here this morning. Radio Free Mobile's founder. Thank you, Richard. Investors are still pouring money into cash despite the Fed kicking off its rate cutting cycle, which could lead to lower returns on money market funds moving forward. Maddie, you're taking a look at this. What do you have?
That's right. So I've got a check on these money market funds. We still have cash pouring into MMFs, despite the fact that the Fed cut interest rates, which is an indication that you're going to get a little bit less bang for your buck, to put it literally, on this cash here. So this chart tracks the inflows into money market funds over the past couple of months here since April. You can see that we are still hitting all-time highs, hitting over $6.4 trillion in MMFs. Earlier in the year, you can see that number was closer to that baseline of $6 trillion. Now, Marvin Lowe over at State Street saying this morning that this was the number one question on his desk yesterday. Him and his colleagues trying to figure out exactly why investors were doing this. Part of the question mark is about the path forward for the Fed. How quickly are they really going to be cutting interest rates? And is there more room to run when it comes to the returns that you can get by parking your money in cash? Another potential explanation for this is the focus on T-bill and chill, the phrase that was coined over the past couple of years amid the Fed's faster than 4 decades of rate hiking, right? Investors being able to kind of rest on their laurels and park their money in cash and treasuries and get a decent return, around 5%. For both of those assets. But still, a lot of the investors and money managers out there have been saying, get your money out of cash now. The Fed is cutting rates. They're on this rate cutting cycle. And while that hasn't necessarily been reflected in returns for money markets just yet, that is going to be coming down the pike. And that's the last big thing that I did want to point out. There is a bit of a delay when it comes to the returns that you're getting on your money being parked in cash and the federal funds rate. So that may be another reason that we are not seeing investors really rushing to get their money out. They still do technically have time. But as we speak with a lot of folks throughout our show, Shauna, there are certainly other investment opportunities that a lot of the experts we speak with are arguing would be a better use of cash right now.
Yeah, certainly down the line here with the new Fed rate cutting cycle. All right, Maddie, great stuff. Thanks so much for breaking that down. Keep right here on Yahoo Finance. We've got much more of your market action ahead. A couple of the top trending stocks here at Yahoo Finance next.
We're taking a closer look at Yahoo Finance's trending tickers. We got three names for you: Dollar General, Wynn Resorts, and Bumble. We'll do them all in 30 seconds each, so let's kick it off. First up, Dollar General getting that downgrade from Citi to sell from neutral, cutting their price target to $73 from $91, citing the tough competitive landscape over the last 5 years. You can actually see the stock recovering a bit, up 0.4%. I think that's because of the broader strength we've been seeing in the consumer discretionary space. But again, the competitive landscape being tough. Dollar General known for value, but they say so is Walmart, and Walmart is tough to beat on price. So bullish signal for Walmart here and a bearish one for Dollar General.
Tough for any retailer to compete with Walmart, especially in this landscape. All right, let's switch it over to Wynn Resorts. You're looking at it on your screen right now. We got shares up just about 5%. The company getting an upgrade to overweight from equal weight at Morgan Stanley. They raised their price target to $104 a share. The reason why? Well, analysts are seeing greater stability in Las Vegas and also growth opportunity in the UAE. They're talking about the fact that despite some of that optimism that we did see play out in the markets this week, the new stimulus measures in China, they don't think that's fully factored in to the stock price right now. And taking a look at the year-to-date performance, we are seeing underperformance relative to the broader markets here, Maddie.
All right, let's get over to Bumble, downgraded to sector weight from overweight over at KeyBank over concerns about the dating app's refresh and new features like opening moves that allows women to pose an opening question to all possible matches, in key contrast to the history of the app, which was focused on male users. Putting that first effort in there. KeyBank saying that it undermines Bumble's core differentiating factor. I also want to mention Lidiane Jones, the new CEO over there, the former CEO at Slack, there for over a year, so tough to see the continued challenges for this dating app company.
Certainly. All right, we'll keep right here on Yahoo Finance. We've got another hour for you coming up. Next up, we're going to get the final reading on September consumer sentiment. Are lower rates enough to boost Americans' fear around the labor market? We will discuss what's next.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day, and we've got 3 market catalysts that we're watching. Consumer sentiment. We'll look ahead at for the week to the next jobs report and the economic impact of Tropical Storm Helene.
Stocks rising after August core PCE, that key inflation print coming in cooler than expected. What will the consumer sentiment data crossing now tell us about how Americans are holding up with inflation? We'll get to that next.
Plus, we push ahead to the all-important jobs report out next week, as the upcoming print will likely be the next big test for the market.
And of course, Tropical Storm Helene moving across the southeast, with some estimating that the damages could read $15 billion. We're going to speak with BCG Global Chair Rich Lesser about investing in weather resilience.
But first, we want to get to some breaking news that we got out this morning. The University of Michigan consumer sentiment coming in above expectations. 70.1 was the index's print. That was exceeding the expectations that we were expecting of 69.4. Also a further improvement of what we had seen that prior reading here of this. So what does this indicate? Obviously, consumers a bit more bullish, a bit more confident maybe of where things stand right now. And digging into some of those projections, the expectations index rising to 74.4 versus 72.1 the prior month. Also, the expected change in median prices during the next year, that actually fell to 2.7%. That would be looked at as good news here versus the 2.8% last month. But Maddie, when you take into account what ultimately this means here for the markets going forward, obviously higher consumer sentiment or a better, feeling amongst consumers, not necessarily a huge surprise given the fact that we did see the Fed cut by 50 basis points, but at the same time reiterate the fact that they were confident in a soft landing.
That's exactly right, Sean. I think it's interesting that this latest data here coming in basically in line, and you can see, of course, stocks still moving to the upside off of that. But what I'm still looking at is from that PCE print earlier this morning, the Fed's preferred inflation gauge, we did see slowing income and slowing consumer spending details under the hood there. Could that be a risk to the market? It points to this broader big question that we've all been talking about. We're kind of on this knife's edge of either, great bullishness, growth for the rest of the year, rate cutting party, or maybe some signs of weakness. All
right, let's talk about this and more. For more on the market's reaction to the September consumer sentiment data coming in better than expected, we want to bring in Ann Milletti. She is the head of active equity at Allspring Global Investments. And it's great to have you here. So I'm curious just your reaction to this print, especially on the heels of the Fed cutting by 50 basis points.
Yeah, it's not too surprising. We look at all of these data points as just another input, but no single data point tends to lead us toward a conclusion. Again, it's good to see a little bit more positive trend, not too surprising after the Fed move we just saw.
Does it kind of affirm the Fed's 50 basis point cut, what we're hearing today?
I think they gave themselves more room by going 50 on the first round, and what comes next, I'm not quite sure. It's kind of a fool's game to guess what they're going to do next, but I do think it leaves more flexibility, and I do think the number that people will be likely paying much more attention to is the jobs number, which is, as you guys pointed out, coming out next week. That is going to be really critically important. That's what people have been more focused on, including the Fed.
And when it comes to the market's reaction to all this, we certainly did see a bit of optimism getting priced in. I guess my question to you is, how much of that, the Fed's future cuts that we would likely see by the end of the year, how much of that has already been priced in, and how does that then factor in to what that upside movement then could potentially look like?
I think that's one of the best questions, because what's interesting to me is this everything is good news again, right? Even potentially bad news is good news, because I think there is this perception that the Fed put is back, and the market's even pricing that in, to your point. And so now that does leave some room, I think, for downside if either the numbers are worse than expected or the Fed doesn't move as quickly as the market believes they should. And so that's kind of the uncomfortable part of where we are and why I don't, even though I'm an equity investor, I lead that part of our business, I don't love to see an uptrend every single day. It's not the healthiest thing for the market.
So then when you look ahead, especially to next quarter's earnings, do you think that earnings are going to beat economic data as the key driver or the other way around? Which one is the winner?
Yeah, earnings have been the winner all year round, and it's hard to kind of work against that because companies have done a really good job managing around any changes that they've seen in the environment. I do think it's going to be harder to maintain the growth rates we've seen. And I think we will get deceleration. Again, when you look at consensus estimates going out to 2025, they're pretty aggressive. Having higher growth rates than we saw in 2024, it's pretty aggressive. Maybe we'll get there, but my guess is we'll start to see deceleration happening in the earnings growth rate.
To what extent?
I don't think that it will be dramatic. I mean, even if we go into a recession, I think it's likely to be mild. I think things are, generally speaking, pretty strong in the economy, but it could take a surprise event just to flip the switch and turn things negatively pretty quickly. Again, I do think companies tend to adjust, and the markets will adjust too.
What's the most likely risk for that?
The funny thing, Madison, is like I do worry about a lot, but I've learned in doing this a very, very long time, the things I worry about the most are generally the things that don't happen. It's always a surprise. It's the surprise events that have taken the markets down 15-20%. And pretty quickly and pretty dramatically. So whether that's, COVID, whether that's a geopolitical risk, some type of war breaking out someplace we didn't expect. Those are the bigger fears. I think the other types of fears can be managed a lot easier by both investors and, more importantly, by companies.
So, Anne, how are you advising clients right now? I guess people are trying to figure out what will likely lead the market higher if we do see this move to the upside. Obviously, we've seen this rotation out of tech. We've seen broader participation. Are you confident that that trend is going to stick? And I guess, what do you think that maybe more accurately looks like?
Yeah, I think the best thing that we could advise to our clients now, and I think this is what I hear our portfolio managers talking about too, is to pay attention to fundamentals. There's a lot of macro noise out there. It's nothing we can control. It's nothing even CEOs or CFOs can control. But what they need to do is focus on controlling their own destiny. So making sure they have the flexibility to shift with changing regulation potentially, changing tax rates potentially, and an economy that could potentially slow or reaccelerate. And so how do you remain flexible? And when you're looking at company fundamentals and thinking about new investments, those are all of the types of questions that we're looking at, and those are, we want to be with the companies that have that flexibility.
Great piece of advice for our viewers. Anne Miletti, great to have you here on set with us. Allspring Global Investments, head of active equity. Thanks so much.
Thank you so much.
Well, coming up, we're speaking with Rich Lesser, Global Chair of Boston Consulting Group. Stay tuned. You're watching Catalyst. Hurricane Helene is pummeling the southeast after making landfall Thursday evening in Florida. Extreme weather events like Helene are occurring with an alarming frequency and are becoming more expensive. In the past 15 years, extreme weather events in the U.S. have sparked more than $1.6 trillion in costs and are happening more frequently, according to the National Centers for Environmental Information. For more, I want to bring in Rich Lesser. He's a global chair of Boston Consulting Group. Rich, it's great to have you here, and thanks so much for taking the time to join us. Let's start with Hurricane Helene, and we're starting there because of the relevance and this unfortunate timing here. Obviously, anytime a hurricane hits, but the timing here that it matches with Climate Week. And I guess I'm curious from your perspective, the amount of money, the damage that we are now seeing here from this rise in tropical storms, in hurricanes that we've seen over the last several years, just what that indicates just about the amount of money that is going to be spent and where that path leads from here.
Yeah, I mean, look, first, anytime something like this happens, you have to start by, our hearts go out to the people that are so impacted by this, and the amount of lives that are affected is enormous, and sadly, that's just going to increase. So you're right. We're at hundreds of billions of dollars a year globally that are now being hit because of climate impacts. Those numbers are going up, as your chart just showed. They're going to continue to go up. The scary part about it is that these are impacts that are happening with a 1.2 degree rise in global temperatures, but at the pace we're on, we're off track. It's going to double. We're heading towards a 2.5 degree plus world if we don't find a way to change course. So what we're seeing today is a fraction of what we're going to see. I think what people are going to start to realize more than they realize right now, it's not just the impact in the moment, as horrible as it is, the lives impacted. It's that things like insurance, the amount of savings that goes to covering these issues. We're watching insurance costs go up. We're watching lack of availability of insurance. We're watching insurance coverage, what is actually covered in a storm, go down. So people are more exposed personally, even if they technically have insurance. I think our focus this year for the work we're doing actually with the World Economic Forum, our own research, is partly on the cost of inaction. I think people don't realize the magnitude of the impacts. And it is striking that it happened during Climate Week, where people from around the world are coming together to say, first, how do we go faster to address it? And second, how do we get better ready for a world of high heat, high flood, high storms? How do we get ready for that world? Because sadly, it's coming to a greater degree than we would like.
So, Rich, from the work that you were doing at BCG, I guess, how do we then best go about addressing that?
Well, first, we need to focus on how we can reduce even faster. And there are many, many opportunities. We've just finished a big report about shifting to more demand-driven the energy transition. Right now, energy tends to think itself as a commodity provider, but in fact, there's a lot of things you can do. We've seen companies like Schneider Electric, Octopus, what happens in solar panels in parts of India that really get consumers excited to take on better technologies because they provide both lower cost and better features, more resiliency, better ability to take advantage of cheap times in the power grid. And so there's a lot we can do to drive better energy demand. There's a lot we can do on the technology frontier to bring down the cost of these technologies. And frankly, government policy can work better with businesses to spur us to go faster. And then second, in addition to trying to drive down the rate of change in heat increasing, we can focus on adaptation and resilience. It has a very high payback to protect things more, and we're going to have to do more of that.
And in the context here, too, Rich, of the AI boom and a partnership like we've seen with Microsoft and Constellation Energy focused on nuclear energy, I'm curious how you're thinking about the amount of energy that AI requires and how these tech firms can approach that with a sustainability kind of mindset.
It's a great point. In fact, it got a lot of discussion this week because in fact, we've just finished a lot of research. The amount of energy capacity for data centers is going to more than double in a very short space of time because generative AI is so power hungry. And we have a number of companies, fortunately really great companies, that had made very ambitious climate commitments before the generative AI wave. And they're working very hard to be able to stick to those commitments, even though the power requirements their businesses are going to have is going to go up dramatically. And having the Microsoft announcement's a terrific one, but I see other companies that have shown such commitment on climate, like Apple, like Meta, like Google, really working very hard to figure out how they can meet those energy demands. And I think we'll see more creative stuff, not just around renewables, but around nuclear, around geothermal, hopefully around carbon capture and storage. I think we will see a lot of creativity, but it's a heavy lift because the amount of power that's going to be required is just enormous.
You know, Rich, I had the opportunity to speak with AT&T, a representative there in their sustainability group at Concordia earlier this week, and we were talking about the energy transition. He brought up a great point just about the importance of cross-sector collaboration and really what needs to happen across industries, what needs to happen between public and private partnerships. And I'm curious from your perspective, just how you see, I guess, maybe what those partnerships maybe more accurately look like and how big of a deal and how important that is in order to ensure that transition is successful.
First, I couldn't agree more with that. And I think the Microsoft Constellation announcement is one of what I hope will be many examples where energy companies and the companies leading the AI wave are going to work together to figure out how to meet these needs. But government policy is going to matter an enormous amount. If you can't build, if it's all theory, you put it on paper, but you can't get a permit done, you can't get the things approved, then you can talk all you want, nothing's going to happen. And so this is going to require governments to work at a different pace, to do their environmental reviews, to do the things that they want to do to protect society, which we all respect, but we all know how much bureaucracy can creep into those sorts of processes, and to have different kinds of players, and including the ones who are going to provide the steel and all the supply chains that go into building these data centers. I mean, this is a remarkable opportunity, not just to deal with the AI opportunity, but to provide capital for other parts of the supply chain so that they have the money to invest, whether it's in green steel or green aluminum or hydrogen or some of the other technologies we need. So this is all about getting people to collaborate within and across sectors and between the private sector and the public sector if we're going to go anywhere near the pace we need, particularly with all the data center power requirements.
And given that collaboration that you mentioned, it brings up the point of M&A and potential increased activity in the space, given that the Fed has started its rate cutting cycle. Rich, how are you thinking about the potential that M&A activity could have in terms of furthering companies' climate goals?
So, well, let's take 2 points. One is it's encouraging to see the Fed act in the way that it did. I think it could have started a bit sooner. Probably like a few years ago on the way up, it could have started a little bit sooner, but at least when it acts boldly. And I thought that 50-point signal was incredibly important, not just to spur M&A, but to give consumers a sign that things like mortgage rates and other loan rates are going to start to drop, maybe not immediately, but relatively soon, to give businesses confidence that they can invest, to deal with the fact that the economy is still strong, but it's feeling a bit more fragile. And I think it's a sign of strength. So I think we have to step back and be appreciative for the Fed for now, at least now, sort of moving at an aggressive pace. And hopefully that's going to continue over the next 5 quarters through the end of 2025. And second, specific to M&A, I agree. If the cost of debt, the cost of capital drops, you open up more M&A. Of course, some of the obstacles to that have also, in terms of getting approvals, everybody knows that's gotten a lot harder. We'll see on that front as well. But I do think there are opportunities, in part because there's so much great climate tech coming along. But at this next phase of growth, that great technology needs backers who can put the capital in to scale it. And whether it's directly, raising funds to stay as a small, venture, a small company, or whether it's being bought by a big company that can throw capital behind it, this is really important. I think one of the real second-order consequences of high interest rates has been slowing the energy transition because it's a very capital-intensive industry. You're substituting operating costs of oil and gas and coal for upfront capital to build wind solar, battery storage, grids, all the different green steel, they all need capital. Capital costs matter enormously, whether it's provided to private firms or whether it's provided by big companies.
All right, Rich, we're going to have to leave it there, but really appreciate you joining us on the heels of both Climate Week and, of course, the hurricane-turned tropical storm as well. Really appreciate it. We're going to have all of your markets action ahead right here on Yahoo Finance, so stay tuned with us for more. You're watching Catalysts.
Now time for some of today's trending tickers. Scan the QR code to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. Kicking off with shares of Moncler as the luxury giant LVMH takes a stake in the Italian fashion house. The deal is seen as a positive move by analysts, given it could provide financial backing and support for Moncler, and is especially welcome given the sluggish demand backdrop that has weighed on the industry this year. You are seeing shares actually both moving to the upside. LVMH posting gains of just about 2.3%. But again, the significance of this, and we said it in that last line there, just ultimately maybe some of the cushioning that this does give Moncler, because we talked about the fact that the luxury sector has been hit by slower spending, very much so on a global basis, specifically though the slowdown in China having a real impact on many of these higher end luxury names. LVMH also taking a hit as a result, Moncler having some challenges there as well. So again, this stake here by LVMH in Moncler maybe shoring up some of that uncertainty. But I think the question, more broadly speaking, Maddie, for this sector is what it's going to take to turn this around, what it's going to take for some of this traction to gain some steam, and whether or not any of the stimulus efforts that we saw in China is that ultimately going to make a difference here down the line?
Exactly. And the degree to which there are so many unknowns in China, it was kind of surprising that we saw that dual move from China, both from the central bank and the government this week, a government that has typically been very anti-stimulus. So what does that indicate about the degree of the weakening that we've seen in that economy? And is there something that officials there know that the rest of us don't, that indicates that that weakness is at a point that could be challenging to recover from? Also, some investors this morning saying that the election could throw some cold water on the China trade as well if we do see any policy changes.
Yeah, and when you take a look at two names like this, obviously it's at the much higher end, right? You're talking about Montclair jackets, which run between $2,000 and $3,000 on average. You're talking about LVMH bags, which are very, very expensive. But each had seen a significant price hike here over the last couple of years, as we have seen input prices, input costs rise to the upside. So yes, it is the top tier consumer that we are talking about, but we're looking at this because it's a trickle down effect, right? Maybe in what this, if we do see weakness within that sector, maybe what kind of worrisome signals that then sends for the remainder of the population. And of course, what it means more broadly for the retail sector as well.
Yeah, really good point, Shauna. We are also keeping our eyes on shares of Intel today after Bloomberg reporting the company rebuffed an inquiry from chip design firm ARM about buying one of its product units. It's a unit that produces chips for personal computers, servers, and networking equipment. The news comes as Intel is said to have received a takeover offer and a multi-billion-dollar equity-like investor from Apollo, parent company of Yahoo. But just want to mention, too, Patrick Moorhead, friend of the show, chips analyst, tweeting about this morning, saying that this news about ARM seems kind of unlikely to him. So good reminder of this reporting coming specifically from Bloomberg. Having said that, I think it makes sense that Intel would rebuff selling off the product unit, which is the part of the business that they are not worried about. Why would you want to get rid of that?
Yeah, and I think this also just throws into the conversation that we've had all week, right? Like, what exactly does the future of Intel look like? And it's no secret. You can see it on the chart right in front of your face right now when you take a look at the 3-month, going back year to date and going back even longer than that, clearly has been an underperformer, especially in relation to some of the other chip makers out there. And I guess how long this weakness will likely persist. And we talked to a couple of guests earlier in the week just about the fact that this could actually be a 10-year slog here for the company going forward. And what exactly Intel looks like 10 years from now is really anyone's guess. When you talk about the fact, the rise of their competitors right now, the fact that they are moving ahead and dominating the AI race, ultimately then the disadvantage that Intel is that at this point in the race, what is going to take in order to shift and regain some of that lost momentum? Obviously, they are getting a lot of investments from the U.S. government. How big of a boost that's ultimately going to be down the line, I think, is something investors are still trying to figure out. But again, it is a company that is struggling, to say the least. Pat Gelsinger, the CEO, they're under a tremendous amount of pressure to really right that ship and do it quickly, right? Because I think a lot of investors are losing patience in some of the performance and in the lack of direction maybe that we've seen from Intel most recently.
Absolutely. It's something that we've talked about a lot. And to your point, a lot of questions about which part of the business they may sell off or if he will go to loan moving forward.
We will see. Yeah. All right, let's take a look at Bitcoin, because Bitcoin has been on the move. It's actually back above $66,000 today, the cryptocurrency having one of its best Septembers ever. Yahoo Finance's Jared Blickery is here now with a closer look at that performance. Jared.
Thank you, Shauna. You know, September is turning out to be a pretty good month, and historically that hasn't been the case. So I always pay attention when asset price like Bitcoin or whatever is bucking seasonality, and that's what we're seeing this year. Now, here are all the Septembers for Bitcoin going back to 2012. You're going to see that's the biggest candle on the chart right now. What was happening back then? Well, that was the announcement of QE3. That was a huge risk-on move for the markets and a very big deal for, I guess, monetary policy and global risk markets. So I've also charted what happened this year with respect to Bitcoin and what happens with respect to the median. And you're going to see we are entering one of the most seasonally bullish times of year. Now, I just said we're bucking seasonality, and clearly we are expecting higher prices, but sometimes you pull forward demand. So I would be careful, like maybe heading into the election, we might see a spike higher into that, and we'll just have to adjust accordingly. I want to close with just charting the price of Bitcoin here. I pointed this out right after the bell. This is today's price action. Here's the year-to-date chart, and it's worth doing one more time. We are just breaking out of this negative trend channel right here to the upside. Beware for false breakouts, both to the upside and downside. Bitcoin is famous for that. But in the longer term context, and here's a 5-year chart, or let's put a 3, there's a 5-year chart. This is simply a bull flag, and looks like we finally might be able to break through the upside. If we don't, probably just going to test the lower end of that range. And I do want to close by comparing Bitcoin to gold. Yes, I'm going to do that. Here, I'm going to do this through ETFs as proxies. Here, the year-to-date price action. And gold has just been a steady climber throughout the years. And Bitcoin, at least with this ETF, has seen a little bit of negative price action. Guys.
All right, Jared Blickery, thank you so much, as always, for breaking that down. Really appreciate it. We've got all of your markets action ahead right here on Yahoo Finance, so stay tuned with us for more. You're still looking at gains across the S&P and the Dow, but the Nasdaq has flipped into negative territory. We'll cover that and more for you next on Catalysts. Stocks climbing still. The Nasdaq, though, flipping into negative territory. This comes on the heels of the Fed's preferred inflation gauge coming in lower than expected. We also had consumer sentiment data indicating more economic optimism broadly. So the next big catalyst for the markets, that September jobs report that's due out next Friday. Joining us now in studio for more, we've got Stuart Kreiser. He is Citi's head of U.S. equity trading strategy. Stuart, thanks so much for being here with us. So I'm really fascinated in the market's reaction to this consumer sentiment data, it seems. Correct me if I'm wrong. That didn't seem like that big of a beat to me, but then there's this optimism around it. And I wonder if that's indicative of the market being a little too obsessed with every data point. What do you think?
Look, I mean, I think both the Fed and the market now are a little bit more, focused on growth data. So any growth data right now is probably going to carry a little more weight than it otherwise would have. I think, the PCE data this morning, largely known, people had a pretty good forecast of that. So, everything is about the growth side of the economy and everything is about the consumer. So I think any data that suggests consumer spending is holding in and you're not seeing the weakness that people are worried that the Fed is worried about, I think that's all going to be red positive for equity markets.
Stuart, how much clarity did we get much clarity when it comes to Fed policy here this week? And I guess I asked that just with payrolls out, and I know in your latest note you called it the belle of the ball here, but how much emphasis is on that next labor print, and what are you expecting there just in terms of what that's going to tell us about the Fed?
Massive focus on the labor market. I mean, what we learned from the Fed is that they're cutting. We're not exactly sure why. Yeah. And that's really the question for markets is, are they truly, the way they wanted to message it is, we're very restrictive, we're going to gradually move back towards neutral while the economy is still in a relatively healthy place. That's hugely bullish for equities. If it turns out that they started cutting because they're legitimately concerned about weakness in the labor markets, rate cuts aren't going to be enough to help equities in in that case, and you're going to trade lower. So the why matters here, and payrolls is going to help answer that.
Are you worried about the weakness in the labor market?
We are, definitely. I mean, our economists have 70K payrolls next Friday, which is a very low number, and I think the market would respond poorly to that. So yeah, our view basically really since early July has been risk reward in the equity markets a lot worse than it has been over the previous 2 years. That's very much related to a decelerating labor economy. And next Friday is priced as a big event, and it is a big event, and it's going to help determine the direction of both policy and the markets in our view.
And how is that impacting your view when it comes to positioning?
Just being very careful. I mean, we think risk reward's tough here. We think you want to remain in sort of higher quality stocks. And if you need to hedge, you're hedging the idea that the market runs away from you, by staying in a core quality portfolio. 2 trading days left basically in the third quarter. What's worked in the third quarter? Utilities, real estate, equally weighted S&P, and quality stocks. And I think that just gives you a very clear picture of the types of things that people are willing to own right now. Even as every headline is the markets grind higher, all that true. But frankly, the leadership has been much more quality and safety for the most part. And I think that just gives you a very clear lens into how the average investor is thinking about things.
So where do you stand on small caps?
Small caps to me is this whole discussion on steroids, basically. Yeah. If the Fed is doing insurance cuts into a stable economy, small cap is going to be a great trade. It's going to rip. If you get negative payrolls, small cap is higher credit risk, higher growth sensitivity. So it basically has the most kind of convexity or acceleration in both directions on this trade. So our view on small cap has been, be very careful with it. It's much more of a tactical trading vehicle. You have to be very, very aware of upcoming catalysts that could impact that trade. What we've seen a lot of institutional investors looking at is, I'll be in small cap, but I'm only going to be in profitable small cap or high quality small cap. That lets me get down that cap spectrum, but also staying in a positive quality trade just in case. So it's nuanced at this point.
Can you own the index though then, or is that even too risky?
You can own it as long as you have tight stop losses, I guess. I mean, our view is that you can own it, but it is a 1 to 3 month trade. I think it's going to be very, very hard to have small cap in your portfolio and you just kind of hold it for the next 6 months, because even if you get a soft landing, our view is you're still going to get pockets and batches of data that look worse than that. And when the data comes in looking worse than that, the market's going to trade a hard landing like it did in early August. And small cap is going to be eye of the storm on that. So you can hold it, but it needs to be either a smaller position or I think something you're kind of risk managing around upcoming catalysts, just given its sensitivity to growth.
Stuart, let's look ahead to November, the election. Right now, when you take a look at the polling, the race is very, very close, to say the least. What are you seeing? And I guess the event then, the outcome, one better than the other for the markets, or what is your read?
Yeah, it's tough to call. I mean, our view since June, when we really started looking at this closely, is it's going to be a 50-50 call right up to Election Day. That hasn't changed for us. It didn't change in July. It didn't change in August when the polls moved. I mean, this is a small number of states with very narrow, kind of vote differentials, and turnout's going to matter. So, our view here is it's going to be 50-50. Who's better or worse? It's a little hard to know. To be completely honest with you, the economic policies seem to be converging rather than diverging. It did seem like in July the markets were responding positively when former President Trump's odds were rising. So it does seem like there is some interest in that deregulatory, lower tax kind of framework that he's proposing. But I think it's really tough. Our U.S. equity strategists have made the point that both platforms actually look equity negative. So it's a big risk event. I think it's very hard to trade directionally because we think it's basically a toss-up. And you're just going to have to kind of grit your teeth a little bit. I do think if you're expecting what we saw back in 2016, that's probably less likely. And if you're expecting what we saw in 2020, it's probably less likely. I mean, this is its own kind of unique event. And again, hold on tight. It's not going to be a fun month.
Well, and given that kind of convergence of policies, it makes me think about the China of it all and the huge rally we've seen this week. But come November, could we see either candidate pouring cold water on that trade? And is that something that retail in particular should be worried about?
I think definitely. I think when you think of it, China is one of the few topics or policies in the U.S. that the Democrats, the Republicans, the average consumer, as well as the business community all agree on. And the agreement there is this has become a bit of an adversarial relationship. So, if you're Chinese policymakers, it's hard to see either of the two candidates being necessarily positive for that. On the China side more broadly, I think the positive side is that the positioning isn't there. Institutional investors in particular have been de-risking China for an extended period of time. So if this initial start to stimulus continues and they're actually able to generate some consumer spending, then and positioning needs to rebuild, and that would kind of be your bull case, I think. The bear case is people have depositioned for a reason, and I think it's going to be very, very hard for Chinese policy to really flip the switch on sentiment here. It's going to take quite a bit, and I know they got their own equity markets higher over the last week, but I'm not sure they've reached critical mass in terms of changing people's mind in the U.S. yet.
Stuart Kaiser, always great to have you, especially here on set. Thanks so much for joining us. Citi's head of U.S. Equity Trading Strategy. Thanks, Stuart.
Thank you.
Let's take a look at Supermicro, the stock moving higher today after plunging yesterday on reports that the Department of Justice is looking into an ex-employee's claims that the server maker violated accounting rules just a few years after settling a bookkeeping case with a top financial regulator. Of course, this development follows the Hindenburg research claims that was published just about a month ago. We want to bring back Sylvia Jablonski, Defiance ETS CIO and CEO. And Sylvia, we thought you were the perfect person to talk to because I know Maddie spoke to you right after we did get the Hindenburg research filing here, and you said that you would be buying the dip on shares of Supermicro. Is that still the case today?
Good morning, and great to be here with you today. Well, it is the case. I am looking to buy. I mean, I actually did pick it up a little bit when it fell, 12%. I think that, there's a risk that this turns out to be true, right? And I think if that happens, then you have a lot of downside risk in the stock. But there's also a risk that whether it's not true or whether it's true, it will be fixed, and the company is just critical to the future growth of AI infrastructure. Some of the biggest blue chip companies actually use their products. They've had a huge tailwind from the AI post ChatGPT moment. At one point, they were up over 1,000%, and so I think that long story short, once this gets sorted, the stock goes back into its meteoric rise. But in the short term, definitely prepare for some volatility.
Are you still buying, Sylvia?
Yeah, so I did buy a little bit on the pullback yesterday, and I did buy it on the pullback, that 25% pullback the other day. And I think from here on in, I'm going to kind of just pause and see what kind of news comes out on the stock.
Sylvia, when it comes, I guess just taking a step back, just look at the valuation here of Supermicro, right? And the massive run-up that we've seen in the stock. And now you have some questions just about the probe from the Department of Justice and a lot of the issues that were reached from Hindenburg. I'm curious how you're evaluating some of those lofty valuation concerns and offsetting that maybe with some of the challenges and risks that could be an overhang to the stock, at least in the near term.
Yeah, and that's the key. It's the overhang that could be an issue for the stock in the near term. So I think when you think about constructing a portfolio, right, you kind of want to have a balance and diversification, long-term buy and hold type of portfolio with well-managed risk. But I think that 5% of your portfolio that you like to allocate to things like hot sauce and tactical trading and these short-term ideas, that's kind of where I have it, just for context for investors. So in my mind, I think that yes, there is some risk in the short term that there's some volatility and some additional pullback, but I don't think that this company is necessarily going away. What they do is critical to the AI infrastructure, and valuations or not, I think it's a company that is going to continue to skyrocket just because of the product that they deliver. Yeah. Now, giving this regulatory overhang, we need to see what the result is, right? We have kind of two sides. We had the Hindenburg data, and then we have the company saying, no, say it isn't so, but then the reports are filed late. So we have to see what shakes out with this. Either way, I think it gets resolved, though, over time. And so short term, I think there's volatility. Be a tactical trader with this and know the risk, right? But it's fine to put on a watch list, too, right? I don't think it's going to start, rallying until you get some positive news about the investigation.
Yeah, and Sylvia, it sounds like it might also be more of a broader-based call just on the straight demand side for AI right now, and what we're seeing in the longer term versus it being obviously there's issues fundamentally speaking maybe in the short term, but in the longer term, you're taking that view and what that trajectory looks like, and that is why this name is attractive, right?
Right. And I can't predict what actually happened with the accounting records until we see the data come out. And so that is a risk. And I think we're kind of keen to see what the outcome of that is. But keep in mind that every single tech company on the planet, in NVIDIA, gets accused of various things. And, it pulls the stock back 5-6% on those announcements, whether it's antitrust stuff, whether it's app stores, things like this. And so we need to see, we need to give them a chance to come out with what the story is here. And I think, kind of good or bad, it's either going to go on or it's going to get fixed.
Sylvia, would an executive change up at SMCI help you sleep a little better at night with those holdings?
It's hard to say without knowing what is, what the facts are in this, investigation and in the filings and things like that. I just don't have enough information. If they're not guilty of anything, then, it's par for the course with the stock. But, it's certainly a hiccup, right? When you're kind of filing reports late and there's all this noise in the market, you kind of just want a resolution to come quickly, but we don't have enough information really to call that yet.
All right, well, we will certainly be calling you again to come back and talk to us as we do get more information. Sylvia, really fascinating call and appreciate you sharing it with us. Thank you so much, Sylvia.
Thanks. Have a great day.
We're going to have all your markets action ahead right here on Yahoo Finance, so stay with us for more. You're watching Catalysts. Meta and Snap both debuting new AR glasses this month, part of a broader effort to expand wearable technologies. So how is the market responding to those launches, and where do we go from here? Here to discuss, we've got Brad Erickson, RBC Capital Markets equity analyst. Thank you so much for being here with us, Brad. I want to start on Meta. What is your single biggest takeaway after we got the announcements about their Orion glasses this week?
Yeah, it's probably not what you're expecting. I think our biggest takeaway was they're going to keep spending money on this stuff. You don't show a prototype that's not ready to go at a huge event like this if you don't expect to continue to spend a lot more money on it. And the read through from that, if they are going to keep spending that much money, is the quarter is going to be really good. That was our biggest takeaway.
Brad, I guess then when you compare that to the street's reaction, does that make sense? And I guess when you're trying to figure out and factoring in just how long it's going to be until we see some sort of trickle-down effect, what do you think that looks like?
Yeah, I think what's going on right now is that there's a interplay between, again, how much are they going to keep spending on AI, to some degree the metaverse, but really more AI and all the compute intensity and the GPUs they're buying. The interplay between that and then obviously what the revenue growth of the company is. And I think management in this case recognizes that they can't just go spend an unlimited amount of dollars unless the business is growing fast enough, right? That's what they need to keep investors on board underwriting these investments for the future. But our take was that they are going to continue to spend. And so the positive read through to the revenue trends in the quarter and for the foreseeable future.
Brad, you're right. I am surprised, especially because of Meta's history over the last couple of years as being really defensive, having this fortress balance sheet, saving a lot of money. And I'm hearing you say that you like the fact that they're going to continue to spend on a product that right now we've got a lot of question marks around. Why do you have so much faith in them?
So I just think it's part of a broader trend, right? Like I don't cover NVIDIA, just to be clear, but so long as demand for their GPUs is incredibly strong, that's coming from a place of strength for the hyperscalers, right? Amazon's AWS business is back to growing almost 20%. Google search at a huge scale is still growing, nicely in kind of the low double digits. Meta grew 27% a couple quarters ago, right? So long as those fundamental trends are good, it gives them license to go out and keep spending on this. And thus, we kind of view this spending as sort of like the tip of the spear indicator. If you were to detect any sort of pullback, it probably is coming from the fact that maybe revenue growth is slowing. We haven't seen that yet. So that's a good thing at this point.
Brad, I want to switch gears here and talk about Google with the antitrust case, and we talk about the regulatory concerns just more broadly hanging over the tech sector. I'm curious, just your perspective, how big of a headwind is this a headwind for Google for Alphabet specifically? And I guess more broadly speaking, when you see this type of interaction or I guess movement here from regulators, do you see this being a larger overhang for these stocks going forward?
Certainly, it's an overhang for Google, and will probably continue to be for some time. Right? The two things going on right now. The biggest one probably is they're trying to the DOJ is drawing up an outline to propose to the judge in the default search case of how they are going to remedy Google's ability to secure default search status on smartphones, particularly the iPhone. They have to have that outlined to the judge by December, I believe it is, and then the judge is expected to rule on that by next August, right? So that kind of gives you sort of a time frame of that overhang. With that said, I think Google CEO was out a couple nights ago basically saying we're going to appeal this. This is going to take several years. We obviously agree with that assessment, and thus we struggle with it. It means that the business probably fundamentally isn't about to change in sort of like a seismic way, even though these things will remain ongoing. So we actually like Google at these levels just because you've got so many overhangs out there.
Yeah, and Brad, that was really the crux of the question, because I think that when you take a look at Wall Street's reaction, your peers' reaction to this, it's largely been brushed aside. Yes, this is significant, but when you take into account just what it means ultimately to the size of the business, maybe it's not going to have a huge impact then down the line. I'm curious, though, as we broaden out this conversation and you're taking a look at regulatory intervention on a more broad-based scale for some of these tech giants, how much are you factoring that into your models at this point?
Not much, I wouldn't say, at a high level. The reason being is, our kind of holistic view across the space, certainly for the companies we follow, Amazon, Google, and Meta, right, that kind of fall into this category. The businesses are so far down the road, right? The train has so far left the station that unwinding the technology and the intricacy and the complexity of what these companies have built to generate to drive their businesses, I don't know that it's possible to totally unpack that. Certainly, the DOJ is going to do their best to remedy this type of situation in that particular case. But we think about, just as an example, right? Let's talk about Amazon selling first-party versus third-party products, right? So suddenly, are you going to regulate Amazon and not eliminate the ability for other grocers and retailers and large-scale sellers to not sell their own first-party products? Like, that seems pretty unlikely to us, right? So you're creating all sorts of let's call it unintended byproducts that could have further far-reaching effects on the economy that kind of opens a can of worms that we think the DOJ probably doesn't want to do.
All right, Brad Erickson, thanks so much for breaking that down for us, RBC Capital Markets equity analyst.
Thanks a lot.
Before we wrap up the hour, we want to take a look ahead at some stories that we will be following as we head into next week. Supply chains will be closely watching for any developments on the looming dock worker strike that could shut down ports across the East and Gulf Coast. The deadline for the International Longshoremen Association and United States Maritime Alliance to agree to terms on a new contract. It's 12:01 a.m. Tuesday. So to put it plainly here in English, they've got until October 1st. And if they don't reach an agreement, we're really focused on the economic impact and what exactly that could look like. When you take a look at some of these estimates out there was a recent estimate from JP Morgan just taking a look at exactly how big of an impact it's going to have for every day that we do see a strike. They peg the economic impact of a strike to about $5 billion per day. So putting that in perspective of what we could see and the economic fallout if these dock workers were to strike.
Yeah, that is a significant impact daily. And we've talked to a lot of guests throughout the week about the potential inflationary pressures, so something that could impact consumers as well. But I want to move on to Tesla. All eyes on Tesla. Huge week next week. The EV company expected to deliver what analysts expect to be strong third quarter delivery numbers of their electric vehicles. Tesla shares up close to 20% over the last month on the heels of a couple of catalysts for the stock, obviously Fed rate cuts, but also excitement over an expected robo-taxi unveiling in mid-October that has been heavily anticipated and also moved several times. So something that investors are very excited about here, Shauna.
Yeah, and we talked to Dan Levy from Barclays earlier this week, and he was very bullish on the deliveries front of it and maybe what that's going to signal ahead of some of those other events. And lastly, analysts are expecting a weak earnings report from Nike on Tuesday, though many are hoping that a new leaf will be turned at the company as longtime executive Elliott Hill is going to be taking over as CEO on October 14th. The big focus also in this report is going to be China sales. We know that that is critically important to Nike's business, so any material weakness there could be a headwind for Nike going forward.
Absolutely. And it's fascinating to me. I always forget about poor Nike because they're so late in the earnings cycle, but a key indicator of how the retail sector is doing and especially how China is impacting retailers, a very significant portion of Nike's revenue. So a lot of news that we're going to be getting from Nike and things to watch in their earnings. All right, well, coming up here, we've got Wealth dedicated to all of your personal finance needs. Ali Canal is going to have you right here for the next hour. So stay tuned and have a great weekend.
Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, a look at some of the best positioned sectors and stocks in a lower rate environment. And timing the market. Realtor.com's chief economist joins us later in the hour to discuss the best time to buy a home. Plus, if you requested an extension on your taxes, your new filing deadline is fast approaching. We've got all of the details you need ahead of October 15th. But first, we take a look at some of the market action 90 minutes into the trading day. We're looking at gains for both the Dow Jones Industrial Average and benchmark S&P 500 after the S&P eked out its third record close of the week on Thursday. Meanwhile, the tech-heavy Nasdaq, which is still on track for weekly gains, is trading right around the flatline. The moves come after this morning's August PCE inflation data came in mostly in line with expectations. Here to discuss the current market state of play and what it means for your portfolio is Matt Powers, Powers Advisory Group Managing Partner. Matt, we just said it, that PCE coming in favorable after that 50 basis point rate cut from the Fed. What sectors are best positioned as we now enter this lower interest rate environment?
Yeah, good morning, and thanks for having me. It looks like it's exactly what the Fed wanted to see, maybe a little bit better. The 50 basis point cut really, this inflation numbers validated that, and it now looks like November cuts are likely. But as far as sectors that we look at, we're traditional defensive sectors. We still expect some short-term volatility as we enter October, which is historically the most volatile month of the year in election years. We like utilities, consumer staples, financials.
And outside of sectors, you also have some stocks that you like, Target being one of those names here. And we've been talking a lot about the state of the consumer, especially a consumer that is more choosy. Why do you like Target?
Target, we're a dividend growth firm. That's kind of our core focus, but they've got a great history of growing their dividend. But beyond that, their recent earnings report, they beat on both earnings per share and revenue. And they've returned to a growth mode after really a long stretch of underperformance. Improved digital sales last quarter, 8% was up, and in-store sales as well. So we just think they're positioned nicely moving forward.
And I want to get your take on the Treasury market, because you pointed out that we're seeing the fifth straight monthly advances for Treasuries, the first since 2010. How should investors be looking at the Treasury market, the bond market, especially as the Fed is expected to continue its easing cycle?
Yeah, on the fixed side, we really say target the intermediate, the middle, and keep some short-term liquidity available. But recent, returns come in two forms. It's interest and appreciation, and the theme really is to move away from the short term, extend your duration slightly before more rate cuts, which, as we know, it causes the underlying value of the bond to appreciate in a cutting cycle. And you need duration to benefit from falling rates. So without it, return's only going to come from the income coupon side. So really, the short of that is just increase your duration.
And we're about to enter October, 1 month before the election, typically a volatile time for stocks. If you're an investor, should you be changing your positionings ahead of November, or should you really try to stay the course at this point?
Maybe a combination of the two. So you gradually shift. I don't think that any big knee-jerk changes before an election are a good idea, because we don't know, obviously, who's going to win the election. So, and as I mentioned before, we like an overweight stance towards the defensive sectors. And the markets in general are becoming much more balanced, and the broadening has increased significantly. And really adding to it, as I mentioned before, the easy, safe money's been made. The days of the 5% yields on cash are slowly going to pass. And we're looking at a reallocation really towards dividend-based and dividend-based ETFs. So some broad-based exposure and capturing higher yields and likely some appreciations as funds flow into this area. Dividend stocks have the highest inflows that they've had in 6 months. So it just appears investors are looking for some low risk returns, longer term type returns.
And I want to let you out on this and talk about inflation. We still have inflation above the Fed's 2% target. There's always that risk that inflation could tick up again. Are there signs in the market or things that investors should be looking out for ahead of that reality?
It's kind of the same thing, what I said earlier. We're already kind of to see, and we'll continue to see, there's a gradual shift away from that short-term fixed side, which that all ties in with inflation, obviously, interest rates. And it's that likely decrease in those types of assets, the money market, CDs, and with our clients, we're seeing it as rates reset. They're starting to look around at some different opportunities. So, I would say that might be a something to consider. But the attractiveness of holding those types of assets as a risk-off return, that option's kind of dwindling at this point.
All right, Matt Powers, Powers Advisory Group Managing Partner. Thanks so much for joining us.
Thank you for having me.
Well, cash is king, so they say. Well, sort of. If you're looking for bigger returns on your investment, equities may be a better bet, but cash can still have a place in a balanced portfolio. Now, when we say cash, what do we really mean? Cash isn't technically an investment. It's not invested in the stock market. It has very little to no risk. So any headlines about a major sell-off won't impact your cash investments much. There are a few cash management products that fall under the umbrella of cash. A cash management account, a money market fund, and a certificate of deposit, aka a CD. First, cash management accounts. They are advertised as combining the best of both a checking and savings account, but instead of a bank, they are offered by brokerage firms. You can deposit cash, write checks, and use ATMs. They also offer an above-average interest rate, which would be the incentive for putting your money there instead of a standard savings account. Next, money market funds. That's a type of mutual fund that has a very short-term maturity. They invest in the lowest risk assets like treasury bills or corporate bonds and focus on stability and liquidity. And finally, CDs. This is a type of savings account with a fixed interest rate and a set term. You'll be insulated from things like rate cuts once you've locked in your rate, but you also can't access that money without penalty for a set period of time. Maturity dates vary by CD from months to years. CDs with a maturity date of less than 3 months are considered a cash equivalent. So why not go all in on cash? Well, cash investments tend to generate much smaller returns than stocks or bonds. That's the price you pay for keeping your money safer. And with cash management accounts and money market funds, interest rates and T-bills are impacted by the federal funds rate. So as the Fed begins to cut, you could see smaller returns in the months to come. Well, the AI trade stumbled over the summer after a monster start to the year. This week, it got a boost from an earnings report and a big new prediction. To break down exactly what we've seen and what might be next, we have Market Domination co-anchor Julie Hyman. And Julie, it has been interesting to track the moves of some of these AI names, like NVIDIA, for example, that's up about 5% this week.
Yes, it is up this week, still down off its highs this year. So I wanted to look, first of all, at what we have seen in the so-called AI trade this year. There are a couple different ways you can do that. There, in fact, are a lot of different ways you can do it. So I'm going to do it in a couple different ways. First of all, by looking at the Nasdaq 100, the 100 largest stocks in the Nasdaq Composite. Now, this index peaked back on July 10th after having this big run-up to start the year of more than 20%. Since then, we've had kind of a downturn and then an attempt at a rally, another downturn, and now we are again in this current attempt at a rally to regain those record highs. The record high, by the way, 20,675 for the Nasdaq 100 specifically. We're off about 3% from those levels. Another way to measure it is to look at the Magnificent Seven specifically. You can do that by tracking it through an ETF, among other ways. Now, this too, July 10th is that magical date where we saw it peak, and it too has seen sort of these ups and downs since then. To your point, Allie, we've seen sort of a comeback in many of these this week and really over the past several weeks, up 1.5%. Another way of slicing and dicing this is by looking at the semiconductor stocks, and indeed, NVIDIA is sort of the prime example of what we have seen here in the AI trade. NVIDIA, too, actually didn't peak on July 10th. It peaked on June 18th, but then made an attempt to do so again, and also it's down about 10% from those levels. So what's been happening recently here that has sort of given a little bit of zhuzh, a little bit of magic back to that AI trade? There's been a couple things that have been going on here. I'm just going to equal weight this year to date to get a better look and find the stock that I am looking for, which is Micron. Micron, a part of the story this week, this memory chip maker coming out with its earnings and an earnings forecast, a sales forecast specifically, that was ahead of what the street was looking for. And in particular, it is demand for its high bandwidth memory product, which is AI related, that is really juicing some of the enthusiasm. The other thing that has been giving a lot of enthusiasm to the AI trade this week is a new report out of consulting giant Bain & Company. Now, Bain said through 2027, we could see an annual pace of AI demand on an annual basis, so each year, of 40 to 55%. That would mean you could see up to $990 billion in demand by the end of 2027. Where is that demand going to come from? Because we're all still trying to figure out exactly what the deal is with AI, how it's going to play out. Well, they talk about a lot of that, at least half of it really being what they call the infrastructure enablers. And Kate Moore of BlackRock, in an interview with us this week, had some interesting commentary about that. She said, we're not anywhere near the midpoint of this AI upside and cycle. And she said, right now we're in the city building phase, right? The infrastructure providers are building the sewers and the streets. What's going to be necessary for then the other stuff to continue to happen? Things like applications, AI-related IT services, which are some of the other things that the Bain report looks for. So obviously, you're seeing huge expectations for gains from here. There is, at least, a little bit of skepticism in some quarters, maybe not about the underlying AI story, although there is a little skepticism around that, but also about the valuations that we have, of course, seen as a result of all of the run-up that we have seen in many of these names. I mean, we know the conversation that we have been having around the likes of an NVIDIA and just the monster gain that it has had still, even with the pullback, not just this year, but over the past several years. We talked to Mike Darda of Roth MKM yesterday, and he said, typically, this doesn't just go up and keep going up. And it also doesn't flatline and go sideways. It does tend to roll over a little bit. He said maybe that's part of what is happening right now. Allie?
Yeah, Julian, that valuation, the demand story, especially when it comes to some of these AI names, certainly not going away anytime soon. Thank you so much for joining us. Coming up, we're taking a look at the latest in mortgage rates. Stay tuned. You're watching Yahoo Finance. Mortgage rates dropped to the lowest level in 2 years, incentivizing buyers back into the market. Yahoo Finance's housing reporter Danny Romero joins us now with the breakdown. Danny, what's the latest?
Allie, it wasn't a week of big moves. Freddie Mac reported that the average 30-year fixed mortgage rate fell 1 basis point from last week. Now, this was the lowest level in 2 years, like you said. Remember, mortgage rates have dropped more than a percentage point since May. And lower rates has been a great opportunity for homeowners. Homeowners who had a 7% mortgage rate are now refinancing. The monthly mortgage payment is $300 cheaper from April. The median house payment is about $2,500. That's during the 4 weeks ending in September 15th. So the big question is, will mortgage rates even move lower from now? And that really depends. Economists at Fannie Mae and Mortgage Bankers Association expect the 30-year fixed mortgage rate will end this year at 6.2%, so higher than the current range, Allie.
Danny, important stuff to keep track of, especially for those looking to buy a home. Thank you so much. Well, if you're strolling through some open houses this weekend, it might actually be a good time to buy one. According to Realtor.com's annual report, we're about to approach the best week of 2024 to purchase a house. Here to discuss is Danielle Hale, Realtor.com chief economist. And Danielle, can you just talk through the seasonality factor of all of this? Because this is really separate from the mortgage rate conversation, correct?
Yeah, that's right. We've got two different things going on. The market momentum, which, falling mortgage rates should help boost momentum, and we should see some additional buyers come into the market. But seasonally, fall is a relatively slower period for the housing market. We typically see demand pull back. It's about 30% lower this time of year than at the peak of the year. And that lower demand, while we still have a decent number of options on the market, creates some imbalance. So we see prices tend to fall seasonally. This year, it could be as much as $14,000 down from peak price. And we also tend to see homes sit for a little bit longer on the market, perhaps 2 weeks longer than they did in the summer this year. So it gives buyers more time to make decisions, and they might see a bit of a reprieve on home prices as well.
We're also seeing a rise in co-buying homes, meaning people are buying homes with other folks, maybe their friends, maybe their family. What are some of the advantages to something like that? And what is maybe a downside risk to something like that?
Yeah, so Realtor.com has done a couple of surveys looking at this phenomenon, and we do see that a lot of people are open to the idea of buying with someone other than a spouse, typically friends, other family members, maybe romantic partners. They're usually doing this to afford a better location, get a more updated home with better features, maybe find some more space. Sometimes, although less frequently cited, people are looking to get into the housing market and start to build equity sooner. So a lot of different reasons. I think the housing market has been challenging for a lot of buyers to get into for a very long while, and people are getting creative and working with friends and other family to make their dream of homeownership happen.
And on the conversation of mortgage rates, we know the Fed cut interest rates by 50 basis points. However, the expectation of the Fed easing cycle that's really been priced into mortgages, which is why we've seen those rates decline. Given that, how much more relief do you expect through the end of the year?
I think we're going to see pretty modest relief between now and the end of the year. I think we're likely to see rates hover about where they are, so somewhere between 6 and 6.2%. So not a whole lot of additional improvement, but as Danny noted, we have seen some increase in buyer purchasing power as a result of the improvement that we've seen to date. So if buyers haven't looked at their mortgage affordability in a while, it would be worth taking a look to see what they can afford, how that might lead to an adjusted home price target, or maybe they want to pocket some of the savings thanks to lower mortgage rates. As we move into spring season 2025, we may see rates drift a little bit lower, but I think it's going to be 2025 before we see mortgage rates that start with a 5 will probably be in the high 5s as we move into the spring 2025 buying season.
So given that, is there any strategy to try and time this market, especially if you're someone that maybe can wait a little bit and doesn't have to move right now?
Yeah, that's a great question. So there are pros for buying now. We're at that seasonal slowdown sweet spot for buyers. So there's less competition, which can make it easier to snag a deal on a home. At the same time, you might see lower rates if you into the spring, but you might have to offset those lower rates with more competition and better prices. In essence, I don't think buyers can go wrong either way. I think if you're shopping and you have a good idea of what you want and you find it and it fits within your budget, it makes sense to move forward. If rates do indeed drop further, that may create an opportunity to refinance. But in the meanwhile, you'll have started building up equity. So buyers are in a really good position right now, the best position that they've seen in quite some time in the housing market.
And let's say you're someone that really is anxious to move, needs to move right now. What should be on that checklist when it comes to looking at the various options out there and really maximizing savings as well?
Yeah, so if you're looking to get a good deal, Realtor.com recently did some research looking at listing descriptions. Sellers that put the phrase price to sell or other similar value signals in the listing description are in fact more willing to make a deal, and their pricing tends to be better. So shoppers can get an 8.5% or $38,000 discount below the median price if they're looking for terms like price to sell. And if you don't want to wait for lower mortgage rates, there are tips to lower your mortgage rate. The number one that results in the biggest savings is to shop around among mortgage lenders, and that can net you a better mortgage rate than just going with the first offer.
And finally, what other trends are really sticking out to you in this very unique housing environment, especially when we think about the affordability factor of it all, along with the differences among regions as well?
Yeah, so the housing market is really interesting right now. The Northeast and the Midwest, which are relatively affordable outside of the major cities, have tended to see home sales and pricing activity do relatively well. In the South, pricing hasn't been as strong because we've seen more building activity. So that's created a lot more inventory for buyers. And out West, we've seen sellers continue to engage with the market a little bit better. So when we look at the West and the South, we're looking at more inventory or the closest regions to recovery when it comes to pre-pandemic levels. So shoppers in these regions have more options and are seeing a little bit better pricing conditions in these regions as well.
Danielle Hale, Realtor.com chief economist, thanks so much for joining us today. Have a great weekend.
Thanks, you too.
Coming up, one study of Americans' legal worries may point to a Trump 2024 win. We'll take a closer look at the numbers next on Wealth.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
A new study from Legal Shield, which assesses Americans' demand for legal services, points to a possible Trump victory in November. In August, the firm's Consumer Stress Legal Index ticked up slightly to its highest level since November 2020. In presidential battleground states, stress rose even more. And historically, that elevated battleground stress during October and November has resulted in a Republican White House win. To discuss, I'm joined by Matt Layton, Legal Shield Senior Vice President of Consumer Analytics. Matt, thanks for being here. To start, can you first describe what exactly this legal index tracks, and how is this different from some of the other national polls out there, which do show Kamala Harris leading former President Trump?
Sure, and thank you for having me today. And you hit it right on. We're seeing 2 months in a row now of increased consumer financial stress. We had a record increase in July for the 22 years of the index, and August not only maintained that increase, but also had an increase in and of itself. And really what this says is we provide legal benefits for millions of people all across North America to the tune of 150,000 requests for service per month. And what that allows us to do is we get out ahead of the issue. We can take the pulse of the consumer instead of waiting for more lagging measures, which are polls and surveys.
And what exactly does the stress lie in? What is making the people that you speak with really on edge?
So our index is really made up of 3 different sub-indices: the bankruptcy index, foreclosure index, and a consumer finance index. Each of those 3 individuals are also increasing over the last several months. But when we speak to our lawyers, we hear issues like job security, layoffs. Folks are concerned about their jobs. They don't have enough money at the end of the month to pay their bills. So, which bill can I pay? Which is okay not to pay? And then even on into housing, what happens if I don't make my mortgage payment? What happens if I can't pay my rent? These are the types of issues that we're seeing an increase in that's causing our index to go up.
And why, at least in this index, do we often see higher stress levels equal a Republican win? Is it because there's just more confidence in GOP policies when it comes to economic revivals?
So really what we're mainly focused on is the data and those correlations. So over the last 5 presidential elections, what we found is that when the stress level in battleground states rise above the stress level of the national, that has shown a Republican victory in the presidential elections. And conversely, when the battleground stress levels are below the national level, that has shown a Democratic victory, again, over the last 5 presidential elections. And what's important about our data in August, and then even continuing on through November, is that in August, that battleground stress level rose above the national average for the first time since February.
And how have you seen the index and therefore the stress levels change throughout the course of the year? And how do you expect something like the Federal Reserve cutting interest rates to sort of ease some of those fears?
Yeah, so I think that's a really, really good question. And again, our index measures people's actions today, which gives us a good pulse on how people are feeling right now. While the interest rate cut is, potentially a good thing for everyone, that doesn't really affect pocketbooks today. And our early September data really begins to suggest that, because what we're seeing on the early data is that consumer stress is continuing to rise, not only nationally, but that battleground stress is also rising faster than the national average currently.
And we'll have to see what comes up in November. Matt Layton, Legal Shield SVP of Consumer Analytics, thanks so much for joining us.
Thank you.
Well, an important tax deadline is looming. What you need to know to avoid penalties. Much more on wealth after the break. You're watching Yahoo Finance.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capsule Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
If you received a tax extension in April, then the due date is just over 2 weeks away on October 15th. We're breaking down everything you need to know, and joining me now is Tom O'Sabin, National Association of Tax Professionals, Director of Tax Content. So, Tom, how important is this deadline, and what happens if you miss it?
Well, it really is important because you just hit the nail on the head that the April 15th filing an extension is an extension in time to file, not in time to pay. So we've had the clock ticking on any balance due since April the 15th. So we're really going to get that return filed for a couple of reasons. One, so we can stop the clock ticking on the failure to file penalties, which can be as much as 5% per month. But we still have the issue of that failure to pay penalty, which also can, yes, the two combination can end up being as much as 25% of the tax. And I want to say something more when it comes to the standpoint of getting that tax return filed. I think many times human nature tells us that, well, if I don't have the money to pay, I just won't go ahead and file. And I think that's really a mistake because one of the things that happens is, well, there's a couple things that happen. One is that the statute of limitations, in other words, the IRS's ability to come back and challenge what was on that return, for a return that isn't filed, the statute is unlimited. When it's typically 3 years after you file a return, when you don't file a return, the IRS has an open window forever. The second thing is, if you want to, for example, work out some kind of a payment plan with the IRS, the first thing they have to have is the return. And what I do is I liken that to, imagine going to the bank to borrow money and the bank says, well, we need some documentation. Well, I don't have any documentation. I just want you to lend me money because I conduct myself well or I speak well. Well, that's the same thing at the IRS. The IRS says, yeah, we'll work with you, but the first thing we got to have is we got to have that return so we know what we're looking at.
And Tom, you mentioned one of those common misconceptions that if I file for an extension, I don't have to pay, but that is not the case. Let's say you applied for that extension, but you didn't submit an estimated payment on your taxes. What's the first step you should be making?
The first step you should be making, number one, like I said, is to file the return because the horse is out of the barn now because the interest and the failure to file penalties have been accumulating since April 15th. That was the due date. So the fact of the matter is, let's get that return filed and at least get that failure to file penalty stopping. And then once the return is filed, work with the IRS to get the payments in. And there's a variety of means to go ahead and do that.
And let's dig into some of those options, because what if you're someone that can't pay or is struggling to pay? What options are available to you?
That's really a great question, Alexandra. And I think that's the point that our viewers should really take away is that, listen, the IRS doesn't want to pull up to your house in a black sedan and pull you away for not paying your taxes. They want to work with you. And the graphic says it all. Let's say, first of all, let's get the return filed by October 15th. Even if you don't have the money on that day, from the standpoint of the IRS even asking, hey, where's the money, it's probably a 4 to 6 week process. Again, interest is still accruing, but you've got some time to get that money together. Secondly, then, again, as the graphic shows, once the return is filed, you can then apply for a short-term payment plan or maybe even a long-term payment plan. I especially like the second one, the long-term payment plan, saying that if you can satisfy that debt within 72 months, that's 6 years, ladies and gentlemen, the IRS will likely accept that payment installment plan. The IRS is going to charge interest, a couple of factors that I want to throw out there, but their interest rates are running at about 8%. which personally I think is a lot cheaper than trying to put your tax debt on a credit card or getting a personal loan in a quick turnaround here. And then secondly, the idea that being that we have that time to get it paid, and maybe that'll help us planning for next year. In other words, if we can put 2023 on a payment plan now, well, guess what's right around the corner? In a little more than 6 months, 2024 tax returns are due. So if we can kind of rectify the situation now and get that moving, then you might be better off in the future. So we can be a little bit reactive and proactive at the same time.
Yeah, that's some great advice there. And I also wanted to get your thoughts on those who are self-employed, because taxes can be very complicated there. Are there certain strategies that cohort of workers should be really implementing?
Absolutely. Great. Again, great question. I've been a tax professional a long time, 30 plus years. Most of the taxpayers that I've had that have financial difficulty paying their taxes are self-employed people. Because if you're an employee, well, that mechanism occurs every payday where taxes are being withheld. Well, that self-employed person has to get into a process of paying estimated tax payments, which we all know the reality in a small business is that cash flow is king. So a lot of times you're just lucky to pay your vendors and your employees, but nonetheless, here you are with a tax problem. But yes, let's say you're getting ready to file your return and you're a self-employed person, you could actually have an impact on that 2023 return. And about the only thing left to do right now would be to set up a self-employed retirement program, which you can establish and fund by October 15th for last year. Now, in real simple terms, what it really means is you can put away about 20% of the net profit of your business into one of these, they call them a SEP plan, self-employed pension. But that's something you could still do for 2023, get it established and funded by October 15th, and that will reduce your taxable income for 2023. And then I would recommend, again, if there's a balance due, I would suggest possibly going the route of an installment plan and then get some estimated tax payments in for 2024, since as we just mentioned, we're a little more than 6 months away from having to file 2024 returns.
Some simple ways to break down what can be a very daunting topic. Tom O'Sabin, National Association of Tax Professionals, Director of Tax Content. Thank you so much for joining us.
It's been my pleasure.
Looking to begin your investment journey, but unsure where to start? ETFs could be a good place. Here to discuss the pros and cons is Yahoo Finance contributor Ross Mack. And Ross, before we get into the pros and cons, I often get asked this question, and for a new investor, this can be confusing. Difference between ETFs, mutual funds, index funds. What's your say there?
I love it. So one, right, I'm always going to recommend when a person is starting out, definitely look at some type of fund, right, which is going to provide you diversification. However, what is an exchange traded fund? What's an ETF? It's an exchange traded fund, which is a investment vehicle that's going to give you the ability to own several different assets across different asset classes, sectors, etc., all within just one individual transaction. And so when you think about, what's an ETF and why you might want to look at it, right, the very first pro of it is diversification, right? Just like I said, you have the ability to own different assets, whether it's tens, hundreds, or thousands, literally just by buying one single transaction. And so when you think about that, why that's a good thing, imagine if you only own travel stocks in 2020 and COVID happened, right? The world shuts down. Guess what? Your portfolio might be down over 50% because you own in airlines, hotels, et cetera, right? So having diversification gives you the ability to have own different sectors where, from a risk standpoint, sure, maybe my travel stocks might be down, but hey, I also might own communication stocks and technology stocks, et cetera. And those are the things that would kind of off-weight or, make up for some of the lack of performance in some of the other sectors. Another thing to think about is overall fees, right? So when you asked earlier, what's the difference between ETFs and mutual funds? ETFs and mutual funds are very similar, however, one's open-end, one's closed-end, right? Or actively managed, passively managed. So ETFs are passively managed, and therefore they're going to have lower expense ratios relative to mutual funds. And why that's big is because over the course of, call it 30 years, 0.5%, 1%, et cetera, that can add up to be tens of thousands of dollars over the long course. And so ETFs are going to be a lot cheaper than mutual funds, right? And then another thing to think about is just the overall liquidity, right? ETFs have the ability to be traded very similar to stocks, and therefore you can buy and sell them throughout the day. Mutual funds, only at the end of the day, right? And so that's something to think about. Now, right, you might have some people that have some, drawbacks. I won't say there are many cons. However, there are some things that will make you say, well, I actually might want to do this, right? And I think one con to an ETF is just maybe it's over diversification, right? So if you look over, the past several years in the stock market, well, technology companies have been doing extremely well. So by being overly diversified, you might own some, retail stocks, you might own some oil energy stocks, right? If you only would have owned technology companies, right, only technology stocks, that would have probably given you a much higher return. So at times it could be a very small negative, right, where it's like over diversification. Another thing to think about are, well, fees, right? At the end of the day, we talked about fees, which makes a ETF cheaper than mutual funds. However, there are fees associated with it, which are expense ratios, which is saying literally there's a professional that's managing this basket of goods. And so ETF are gonna have fees that are obviously higher than just buying individual stocks.
And on your new podcast episode, Financial Freestyle, you dive deeper into the ETF conversation. Who'd you speak with? And can you give us a little preview into that episode?
Yes, it's a phenomenal episode, right? Like at the end of the day, if you're just starting out investing, my first investment recommendation will always be ETFs. Diversification out the gate, right? If you look at the S&P 500, the average return over the past 30 years is roughly 10%. And so when I talked to Kristen Myers, who's editor-in-chief at ETF.com, we actually talked about a lot of strategies that help a small investors actually start understanding, right? Being able to go to ETF.com and look up, say, hey, I actually want to look at semiconductors. There's a lot of talk about NVIDIA. So you can actually just type in NVIDIA to see which other actual ETFs own NVIDIA. So it's a phenomenal episode coming out Monday.
Love it, love it. Thank you for the teaser there, Ross Mack. You can catch his podcast, Financial Freestyle. New episodes every Monday at 12 p.m. Eastern. Can't wait to tune in. Thanks so much. Coming up, it's almost holiday shopping season. We dive into the trends to watch next on Wealth. Costco. It's one of the hottest memberships in the world with over 128 million cardholders globally. 3 types of Costco memberships exist: the base, also known as Gold Star, Business, and the Executive membership, which is the highest tier. All 3 had their first price hike in 7 years, with prices officially rising on September 1st. Today, Gold Star members pay $65 per year to get access to Costco online and warehouses. It also includes 2 free membership cards, so you can bring a friend and shop for some big deals. And if you own a business, the business membership is for you. It's pretty much the same as a Gold Star, but you're allowed to purchase for resale. Now the highest tier, the Executive membership. It's double the price of the Gold Star and Business tiers, clocking it at $130, but there are some added benefits. There is a 2% annual reward on all eligible Costco purchases for up to $1,250. So if you spend $500 a month at Costco, you'll get $120 back annually. And there are some extra discounts on Costco services as well. Just like the Gold Star membership, it comes with 2 membership cards. All 3 of the memberships gets you exclusive access to the wholesalers' warehouses, where you can buy pretty much anything and everything, from music instruments and jewelry to even a barn. And of course, the infamously hard-to-get Costco Gold Bar. But ultimately, a membership isn't right for everybody. First, if you don't live near a Costco, it probably is not a good idea to get a membership. And you also need to evaluate how much use you would actually get out of that card. How many people live in your home? How often do you plan on going? How much do you plan on spending? All questions you need to ask yourself before coughing up that annual fee. It's almost time for what will be a shorter holiday shopping season, with only 27 days between Thanksgiving and Christmas. Now, shoppers are starting early, with 3 quarters beginning to see out holiday deals, according to a new consumer spending report. Joining me now with more insights is Ed Holland, Klaviyo co-founder and chief product officer. And Ed, I was surprised going through this report to see that 26% of the shoppers you polled said that October is the best month for holiday shopping. Feels a bit early to me, but what's the motivation behind some of these earlier shopping trends?
Yeah, I think what we're seeing is that customers are really feeling inflation. And so people are spending more on essentials and do expect to equally spend on the holidays this year, if not increase spending. But they're very focused on price, and they're very focused on deals and discounts. And so what we see is that customers are totally willing to start earlier and think about where they can make their money go the furthest and find that best deal during the holiday season, even if that means going ahead and buying in early October.
And is there an ideal time to shop when it comes to finding some of those best deals? And does that differ whether it's online or in-store, brick and mortar?
What we see is that it really depends by brand. And so the key thing is that, consumers think about all the different ways to connect with brands, whether that's browsing in person, whether that's signing up for their email list, their SMS list. Different brands approach where the best discounts are in different ways. And so the key thing for consumers is just think about, if there's a brand out there that the person you're giving a gift to loves, make sure that you've signed up for that email list, signed up for that SMS list, but also look in store and go to their website online.
What exactly are people spending their money on these days, especially as we've seen a more choosy consumer amid higher prices?
Yeah, in some ways we haven't seen that change. So the thing that applies, basically across all age groups, across all generations, is the top category is fashion, so apparel and accessories, followed by effectively hobbies. And so other than Gen Z, where we see that the second most popular category is watches and jewelry, for all other age groups, it really is, whatever those hobbies may be, that's where consumers are focused. And the same is true. We see that parents spend a lot more during the holidays. They're much more likely to spend over $500, but it's still the exact same prioritized category. So it still comes back to fashion and fun. And even with the different inflationary environment, it really hasn't changed, where consumers are focused.
And I also want to talk the TikTok effect. How has social media impacted shopping behaviors?
Yeah, social media is everywhere. Nearly every consumer talks about how they're likely to be influenced by social media in some way. I think something that really surprised us coming out of this report is that, we've seen a lot of brands very focused on these glossy, large, campaigns with celebrities and influencers. And while we see those are certainly important, we actually see that consumers they're 4 times more likely to actually be influenced by the rest of their social media. So those day-to-day relationships on TikTok or Instagram, are much more likely to influence buying behavior than the one-off big celebrities or influencer campaigns.
Yeah, that's something I think that has been a change over the past several years. Another thing I want to point out is price over quality. 70% of consumers selected price range and say they prefer, a cheaper option over the quality. What does that say to brands that are maybe looking at their inventory and thinking about things like discounts?
Yeah, so I think what we see is that consumers still desire quality. So the second most common cited factor was quality. But they're gonna, really want strong value for their dollar. So I think for brands, it's thinking a lot about, okay, who are the consumers that we know love the brand? What are the ways that we can build those relationships and offer those discounts? And consumers are going to be looking for them. Really across all consumers, we see that across spend levels. If they're spending little on the holidays, if they're spending a lot, they're looking for discounts and they're thinking about where they can make their dollar go a long way.
And are you seeing any year-over-year comparison trends yet when you look at last year or even pre-pandemic? Has there been any differences that you've seen this year that stick out?
Yeah, I think it's been a surprise. We thought that when customers, everyone reports feeling inflation, they report, feeling the price of essentials go up. We're seeing that, consumers don't intend to cut holiday spending. In fact, they actually intend to increase it. And so the big change is just how they approach the whole holiday season is that people are more focused on discounts. They're more focused on getting value for their dollar, and they're willing to start earlier in the season to actually make that happen.
All right, well, holiday shopping season quickly approaching. I need to get started on my shopping as well. Ed Hallen, Klaviyo co-founder and chief product officer. Thank you so much for joining us.
Hey, thanks for having me.
Let's do a final check of the markets here. We're seeing the tech-heavy Nasdaq take a leg lower here, off about 0.3%. We're seeing the Dow up nearly 1% on the day, where the S&P 500 is pretty much flat. Now, if the S&P closes in the green today, it'll be the fourth record close for the index this week. So we'll continue to track that. But for now, that's it for Wealth. I'm Alexandra Canal. Thank you so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.